All right, good afternoon, everybody. Thanks for joining us at the afternoon investor track. It's going to be a lot of fun. My name is Felix. I'm the host of the Forward Guidance podcast, and I'll also be emceeing this whole track afternoon. And then we'll also be appearing on the last section. We'll be doing a live roundup of the Forward Guidance podcast. So that's the plan for the afternoon. Super excited to be here. It's going to be a ton of fun. And I would love to just get a round of applause for our first host for the panel here. Well, they'll be talking about all things how to value crypto assets. So give a warm round of applause for our first guest here. We got Matthew Siegel from Van Eck. We got John Charbonneau from DBA. And last but not least, our moderator, Ryan Connor from Blockworks. All right, let's go.
All right, let's do it here. Okay. What's up, everyone? Thanks for joining us today. We're going to be chatting about a my favorite topic in crypto because it's so controversial in analyst circles. It's valuation, and we have two kind of experts on that topic here with us today. Do you guys just want to do quick, brief intros? Tell us about what you do in your firm.
Sure. Everyone, my name's John. I'm one of the two co-founders and partners of DBA. Pretty, I'd say, traditional venture fund. Primarily, we do private venture deals. We also do some liquid in there that looks similar profile of like typical, very concentrated book, long-term investments. We're generalist across different sectors, but in practice, we end up a lot, particularly infrastructure-focused, low-level stuff.
Hey everyone, Matthew Siegel at Van Eck, run the crypto research and manage one of our token strategies. At Van Eck, we have early stage venture strategy, we have liquid token strategies, and we have active equity strategy that's should soon come to market. So we're involved kind of across the whole life cycle. We also have a stablecoin and an NFT platform. Yep, that's us.
Awesome, thanks guys. So I guess just like kind of level setting here, when I look at what both of your firms do and like from the perspective of a crypto native person, like I would say Van Eck is more on the TradFi side, just historically, very traditional firm. And we have DBA, which is very crypto native. So like two kind of like polar perspectives here on how we tackle valuation in crypto. And I guess just like level setting, Bitcoin historically has been viewed as a commodity or a money. We now have thousands of tokens that are trading, all with different tokenomic models, may or may not accrue cash flows. So just like broadly, like do traditional valuation metrics apply in crypto markets today?
Sure. So while we are the crypto native side here, I'm also, I'll call myself reformed TradFi. Came from a traditional banking background, was actually how I started before coming into crypto. So certainly at least colored by that. At least to me, what we spend I'd say like a reasonably meaningful amount of time on compared to a lot of other investors is definitely like thinking about valuation frameworks and just like what are the fundamentals of a lot of these assets. And so while this isn't going to end up being, you have a very specific cash flow model that in most cases, you're going to be spitting out, this is, exactly the valuation that we want, the cash flows are very predictable, we could forecast forward the next 10 years what we're going to get, we're going to get a 4% growth rate. You just don't get that with the vast majority of crypto projects. One of the big difference for crypto versus a lot of traditional markets is that even the public projects that are fully liquid, these are still venture style projects at this point where they're very, very volatile and still very early stage, and you're not be able to like confidently project a lot of these cash flows. That being said, you do have to still have a strong understanding of like, okay, does this have the market outcome possible of, can I get those 100x returns, and a lot of that, what that will end up coming from fundamentally is, can this thing generate a lot of cash flows? So, like as a literal example, if you were buying Sol, it was one of the first investments that we did in our first fund a couple years ago in mid-2023 was, you want to have a decent understanding of like, okay, I can project out, I can see a world where, Sol is capturing billions of dollars of revenue from the MEV and the fees and everything on the network, and, I can back into a reasonable valuation based on where we're buying today. And that was the kind of framework that you have. but you're not going to end up with, okay, I'm projecting exactly these are the cash flows that Sol is going to get over the next 2 years, and I'm going to back into a DCF. The discount rates and everything would end up being ridiculous in most of these scenarios. So TLDR, I mean, like the basic rules definitely apply of cash flows and stuff like that do matter a lot, but in practice, pretty much all of this stuff is very early stage where you're looking for, is there the potential to get this, large growth in that over, a few years.
I used to say that crypto token prices were based half on fundamentals and half flows. I've reformed those views. I think it's 90% flows and 10% fundamentals, and you can see that in the market cap of XRP versus Ethereum, and just look at how much economic activity goes across Ethereum versus XRP. Like the market caps should not be the same, but they are. So you have to, I guess, respect the tape. One adjustment that we've made to reflect that is just being even more selective in what projects we're going to back. You may have noticed many of our competitors have been throwing a lot of single token ETF at the wall this year in terms of filing. We've been much more judicious on that and instead doubling down on our active strategies. And it just means that we're passing on more investments because the active strategies are looking for great doxed teams that are building products that are better than the TradFi equivalent, where the token should be able to actually capture value over the medium run. I can't say that those types of projects have outperformed in this tape. So we're just, we've pivoted more to equities, frankly, where traditional valuation metrics are more applicable, and kind of doing some cross-vehicle valuation. So the venture team knows how their private companies are capitalized and what their valuation should be. We use those insights for the liquid token strategies. And then I've noticed that the equity markets are starting to price in some of the developments in Bitcoin and the other tokens a bit more directly. Like one example that comes to mind is when Phantom Wallet raised their last funding round, and it was a $3 billion valuation, and you had a publicly traded comp, Exodus, EXOD, that was trading at several $100 million market cap. So that fundraising event made the public equity look terrifically cheap, and actually then the public equity promptly doubled right after the Phantom fundraising. So we're trying to apply some of those comparative approaches, but the name of the topic here is empirical, which I looked up in the dictionary beforehand just to make sure, and it doesn't really apply because this is a new asset class, so you end up with a lot of comparative valuation and sentiment-based approach, where a new token comes to market, it's likely to be overvalued because it's a retail audience. We want to wait for it to come to market, go through the trough of disillusionment, typically down 90%, reevaluate there, and see if we can get a true kind of cash flow-based upside.
Interesting. So one thing I didn't hear there in either of the explanations was something like moneyness, or the collateral value of a thing. But I did hear sentiment. There are these crypto native stories that we tell one another that explain perhaps a valuation premium, perhaps the interesting ball that we see in the market on these assets. What do you think about those more crypto native angles on valuation?
I think all of the L1 tokens have to be money for them to work. And the moneyness for a token, I just say, is the same as the PE valuation on a stock. And that's assuming that fundamentals matter. But if there's $3 billion in Ethereum fees that were paid last year, why can't we put a 30 times multiple on it, say, which is what an investor might pay for a high growth software as a service company, and arrive at $100 billion valuation, or whatever the numbers are. I do think that is a legitimate approach, and moneyness is oftentimes no different from just paying in advance for a future stream of income. So I think that when Anatoly talks about Solana not being money, that is not true. He's just trying to be careful in front of the regulators who are watching. but all of these tokens need to be money to work because they need to be used as collateral for other purposes, and that's what makes the velocity of money higher on crypto and eventually accrues fees. So moneyness is important, in my opinion.
So I definitely think it's important in ways. I also think that crypto people will just call everything money, like whatever their token is, because it very often just like sounds good. And the reality is, I mean, you can go into the fundamental, like what are the different roles of money and the medium of exchange, unit of account, blah, blah, blah. But TLDR, I mean, like these assets do definitely look different than traditional equities. I mean, like they are concretely used in a lot of these ways, whether it's collateral in DeFi, all these different things. For a number of assets like ETH, that is like definitely the case where you actually like do have cash flows, and then the like gigantic exception is obviously something like Bitcoin. Like there is no PE multiple. I mean, it is strictly a negative PE multiple at all times. Like you're just being inflated away and losing that value. It's not going to the token holders. Something like that. I mean, what you were saying in kind of your first answer of like we're looking at flows. I mean, flows are the moneyness almost kind of at that point of like, are there more buyers than sellers? I mean, that is what a money is. Like, are people just like using this as a store of value? And Bitcoin is obviously, I'd say, very different in practice from the majority of assets. I think a lot of people want ETH to be in that category because it makes it easier, I think, to ignore the fact of like, oh yeah, maybe we just don't need to generate fees or get a lot of activity in these things, and we could just say it's a store of value. I think in practice that's like going to be difficult for most of these L1 assets, and they're going to need to show something like, you know, are they capturing meaningful REV, the kind of fees and MEV from the network, that like there actually are good yield dynamics for holding this token, which, I mean, something like Sol, where, I mean, over the past couple of years, where there are genuinely just billions of dollars of fees going to the Sol holders. And then, yeah, I mean, you can start to throw a multiple on that kind of thing. I think it's still hard to put like any kind of reasonable multiple on most of these things because, again, I mean, how predictable are these cash flows? Like going forward, you could easily see these things moving 10, 100x in either direction of like the revenues up and down, like very reasonably. But yeah, there's generally just like a wide range. Of Bitcoin is this very special exception where like the P and everything just goes out the window. And then most other stuff you're looking for like what are some general tokenomics that we want here of like it actually is generating earnings. The token holders do get that there is value capture.
Yeah, you mentioned tokenomics. I think the interesting thing about crypto is that we play interesting games with the structure of the token. So like vote locking or these like predetermined inflation schedules. I don't know, do you have thoughts on how those might impact valuations? How do you think about them when you're making decisions?
The inflation one is the one that I'd say probably has played a large role and is a big difference in crypto versus like a lot of traditional metrics of, I mean, like basically all of these tokens generally, you know, some percent of them are staked, whether it's 60%, 70% value, varies based on the network, that are like actually capturing most of the fees and the inflation rewards. The inflation rewards are not like actual value created by the network, and yet, you know, some subset of token holders may like want those, and like they will actually be able to capture them if not everyone is staked. And this is the tricky one where a lot of people, I think, like treat inflation like incorrectly, where you'll see a lot of people take like a pretty simple and I think incorrect calculation of, you know, when trying to calculate like what are the earnings or the profitability or whatever this network, and they'll take like what are the fees being paid and then subtract out the inflation. So people do that all the time, and it makes absolutely no sense. That is like one of the like simplest calculations I see people do all the time that is just like very silly in crypto. And that's just incorrect. I mean, like the token holders can get that. The thing that gets very tricky is, you know, what percent of token holders are actually like getting that inflation, and what kind of assumptions do you want to make around that? Because you can actually have like a positive real yield from getting inflation if you think that, you know, the staking rate is going to remain relatively low because maybe there's a high utility value to using this token in some other way. And so only 20% are going to be staked. And so that inflation like is actually like real yield that I am getting. And so these kind of dynamics like do meaningfully shift across different networks. And so just like understanding like where you are in that network and how they look across each other, those can be meaningfully different. And how the inflation is used is also a big difference. Of like most of these proof of stake networks, you can stake the token and just like get it. But a lot of other like L2s and other chains they will just have inflation that they will just like hand out as incentives. And that's just like a pure loss to all the other token holders.
I think there's two major elements to inflation. The first is to use a TradFi analog. it's quite common for an early stage growth equity to be issuing a bunch of stock because they have high capacity for reinvestment, and there's a lot of demand from the marketplace, even if it's dilutive. And as long as the company is growing quickly, it's okay to pay a bunch of new shares in compensation to employees or dilute existing shareholders in a new round. But if your growth slows down to zero and you're still printing a bunch of new shares, it's likely that your stock price is going to be punished pretty badly. So when we look at the crop of like L2s that came to market kind of 2023, 2024, what you had was like very high inflation rates and starting from high TVL, but then they didn't really grow and you couldn't observe meaningful kind of fee momentum, and in that case, the inflation kind of is functionally a cost because it's these new tokens for whom there's no logical buyer. So that's unattractive tokenomics. And then the second is around the predictability of inflation, and we kind of had this debate with Solana over the last couple weeks. Yes, Solana inflation rate was high, but they had a better mousetrap for some period of time, so it was okay in my TradFi example to like print new tokens because it was seeding an ecosystem that had high demand. And the predictability of it, the inflation rate falling by 15% a year, at least gave people the opportunity to model with high certainty what supply might look like in a couple of years. And then transitioning to a more fluid model where the staking rate or the inflation rate may depend on the proportion of tokens that are staked. That introduces some more uncertainty into the markets. The markets don't love uncertainty, and all things being equal, you might pay less for that type of uncertainty. So those are two ways that I think about inflation.
I want to go back to the premium that we observed in markets. I'm going a little bit off script here. Most tokens command very high valuation premiums on the market today. Do they deserve them?
Most of them don't. Would be my like short answer. I would say a lot of them do not. And I mean, part of this also just goes to like token supply. I mean, like a lot of like newly launched tokens, for example, like tend to have a small percent of the supply, which makes it like very difficult to buy any of these new tokens. And so maybe they are like justified on a market cap basis, but not like an FTV, which is maybe a separate point. But yeah, I mean, a lot of these are not going to be justified by it, but this again goes back to that point of like a lot of these like public, projects. I mean, these are still venture style like outcomes that you're looking at that are like, these are very small early stage projects that, yeah, 95% of them are going to fail, and then a handful of them are going to be 100x, 1000x, and like you're able to underwrite that risk. And then you have, I'd say, a lot that are in that kind of middle area of, people are assigning this like, oh, this L1 moneyness premium to it, and I think that lets you just like get away with a little too far with like a little bit of a ridiculous multiple when when you're talking about like multiple 100x type of PE, where I don't actually like see a path to like getting any kind of cash flows out of these in the long term. What you need though is just to see like, is there a reasonable path to getting those cash flows in the long term? Like I don't care if it's 1000x or 10,000x PE today. It's like the whole point is like the thing just says, it's pre-revenue, it's not making money yet. So yeah.
Yeah, I think it comes down to position sizing, because the cardinal sin as a fund manager in a sector or asset class is like, if the asset class works and you don't return, your fund doesn't return, then you got to make the money in a bull market. And when you look at post the election, what tokens worked the best, the Cardanos, the XRPs, projects that don't really have meaningful fees, but that are so illiquid that just a whiff of hope and deregulation and innovation produces these incredible returns. So we kind of look at, we have core positions that could be a 10% plus position. Maybe it's a traditional equity like a Coinbase, or a real kind of revenue producing project like an ETH or a Sol, and then we have fringe 3 to 5% positions, and then moonshots 1%. So to go into something at 1%, you don't need to tick all the boxes of great team, product market fit on the product, and return to token holders. Maybe you hit 1.5, but you see a path to all 3, and so you'll take a tiny position flyer on something without meaningful fees. But I agree, like at the current levels of economic activity, vast majority of tokens, don't have a logical buyer.
We have like sub 30 seconds left. I want to get your guys' take on technical analysis. I cannot go anywhere in crypto without seeing lines on charts. Do you guys use TA?
I have never drawn a line on a chart in my life, and I do not know what any of the lines on the charts mean, and I do not plan to change that.
I use TA for Bitcoin. I think it plays into like, you can know from the Bitcoin blockchain whether every coin is in profit or loss. And so there, you can start to observe levels of resistance and support that correspond to those levels. And Bitcoin, the inflation rate is so low that generally price equals market cap, right? But when you look at some of these high inflation tokens, you may be looking at the price chart and it looks nothing like the market cap chart. And so which do you want to perform technical analysis on? Probably the market cap chart is more appropriate than the price chart. So the TLDR on that is I do not use technical analysis for altcoins, only for Bitcoin.
Awesome. Thanks, guys.
All right. I love that point there at the end that it's essential to be looking at market cap in crypto as opposed to always just the price chart, because it can just be a completely different world once you start to look at that. Okay, next up we have a stacked lineup and panel here. We're talking about crypto native fund management, challenges and opportunities. We've got John from Theta Capital. We've got Sumit from Nav Fund Services, David from Coin Fund, Alan from Red Belly Network, and Sharon from Multiply. So give it up for these guys, get them on here, and let's get going.
Brilliant. Well, fantastic, fantastic to be here. Thank you very much to the Blockworks team for having us here. Yeah, we've got a panel now on which is close to my heart at least, challenges and opportunities in crypto native fund management, and we've got a great panel to discuss these things. I think everyone's got their own fairly unique insight into this, so it'll be great to go through a couple of things. You know, we've got the crypto native fund management itself. We're going to talk about yield, we're going to talk about capital efficiency, and we're going to talk about operational challenges, of which there, of course, are a few. Maybe just to kick it off, does everybody want to kind of say who they are?
Yeah, I can start. Hi everyone, nice to meet you. Sumit from NAV Fund Services. I currently work as the VP of Fund Accounting. NAV is an end-to-end technology-driven fund administrator. We are pretty active and prominent in the crypto space. We work with a lot of fund managers where we provide them accounting, investor onboarding, AML, KYC, so a full suite of fund administration services. As a disclaimer, we are not crypto native. We have a large part of our business on the traditional side. But I think we have managed to kind of leverage the technology and the expertise that we have on the traditional side to the crypto space. So pleased to meet you all.
Hi, I'm David Packman from Coin Fund. We're a 10-year-old crypto native investing firm. We have 3 investment strategies. We operate a seed fund, invests in the earliest stages of pre-seed and seed stage crypto projects. We have a more traditional venture fund that sort of focuses on like Series A stage venture opportunities in crypto. And then we have a liquid crypto hedge fund. And we focus really on all the different subsectors of crypto and take a very long view on how to deliver returns for our LPs. We are a client of NAV as well as our fund administrator.
Hi everyone, Alan Burt from Red Belly Network. We're a real-world asset-focused Layer 1 blockchain. We combined a patented consensus algorithm with identity and privacy primitives to enable real-world assets to trade compliantly. We're doing a lot of work in the funds space and trying to connect the next bunch of real-world assets on-chain, and that's where we launched in December. We've got about 700,000 KYC users on the platform today, and about $25 billion worth of assets currently on platform, with a bunch more in the pipeline.
everyone, this is Sharon from Multiply. To simply put, we help institutions access DeFi and get yield in DeFi in the most easiest way. We manage over hundreds of $1 million in assets. Thank you.
Brilliant. Yeah, I'm John Vimal. I'm a managing partner at Theta Capital. We're one of the largest fund of crypto native VCs in the space. Yeah, we were founded in 2001, but we've been specifically in crypto VC since sort of 17, 18. I should also, full disclosure, say we are invested in multiple coin fund funds, and actually, Sharon, underlying, we're invested in you as well, but we can get into that later. Now, so we're going to start with the fund management side, which I think you know, David and I are sort of specifically in. David, I'll ask you a couple of questions, and then to sort of make it a bit interactive, I'll ask myself some very probing questions as well. But just to sort of get into it, and your perspective is quite unique here because you've got a background in traditional VC as well, and there are obviously some quite sort of idiosyncratic dynamics in crypto VC as well. You know, how do you go about sort of portfolio construction, and maybe you could weave into that your experiences.
Sure. So I spent 13 years as a traditional software-based VC at Venrock, and so I think on its face, like crypto VC is trying to do the same thing. Your sort of similar portfolio theory of, depending on your fund size, you know, 20, 30, 40, 50 investments. You're making them at different stages in the value creation curve, depending on your fund size. And you're backing teams who have not yet built a whole lot of economic value and hope that you can help them build that. But what's different, of course, is the mechanisms for capturing it is more than just equity. You know, in traditional software VC, that's the only capital formation instrument you're really using. So you're buying equity in a company. But in crypto, we capture value either through equity or tokens, or sometimes both. And so as a crypto native fund, you need to be comfortable with both. And there's a bunch of implications about doing that. One is you need to find LPs who are friendly with you investing in tokens, which have, as you heard on the last panel, questions about how they're valued and when to buy and when to sell. But you need to find fund administrators who understand how to measure, and you need auditors who will help you audit it. Sometimes you need custodians who help you custody it. So things get a little different. Fortunately, we're a decade or so into some of these questions, and so they're now our service providers. But so I think the portfolio theory is similar, but the instruments for value capture are different, and the opportunities for liquidity are different, because oftentimes the tokens go liquid long before the equity does, which presents some questions for LPs. How do they get that liquidity? Do we send tokens back to our LPs? Can our fund administrator and infrastructure distribute tokens back to LPs? Do they want those tokens, or should we be selling them on their behalf and sending cash back? And how are we doing that? Is there a fee associated with that? Do you use your own trading desk? Do you have counterparties? So lots of cool questions that I think we've spent 10 years trying to think through, but hopefully that helps.
Yeah, absolutely. I think from our perspective, it's interesting as well that we have a slightly different approach to the space. You know, we're a fund of funds. We really want to be a fund of funds. And the thinking behind it is sort of, you know, we like to think and this sounds a bit pompous, but like we're like a sort of a generalist VC, or maybe the generalist VC fund in this space, and that we really have a satellite view, and we really try objectively to map out the areas where we think you're going to get the largest outcomes. And in order to get that exposure, and we want that exposure at seed round valuations, we kind of figure out who are the right funds to partner with to get us that specialized exposure. You know, we and that's kind of what we do. We really try and get meaningful look-through ownership of underlying projects, and for us, the only way to do that on a big scale is through very specialized VC funds. I suppose there are also other things that are quite specific to being a fund of funds. For instance, buying distressed secondary LP stakes, right? I think that's something that there are not many groups out there who really understand the underlying portfolios very well. And we've been also have a hedge fund business. The trade in '08 was to buy Lehman Brothers claims, and that was a great trade. But what was an even better trade was to buy those Lehman Brothers claims at a significant discount from distressed sellers. So we do that as well. Our 2023 vintage, for instance, is like 23% distressed LP stakes. So there's just a lot to do there. There's still a lot of inefficiencies, and we love using that as also for our portfolio construction. So we've talked now a little bit about the construction itself. There are also certain risk-reward metrics that you kind of have to deal with, David. What are your thoughts on that?
I guess, do you mean like, will there be a higher percentage of failure in crypto VC versus traditional VC?
Yeah, well, not necessarily versus traditional VC, but how do you assess, I suppose, the risk when looking at projects?
Yeah, well, I think in some ways it's similar to like the same odds. It's a start. These are software startups, really, at the end of the day, right? Most of them are creating networks or applications. And so there's the same set of analysis, like what has to go right for this thing to be worth 100x or 1000x or even more than that. But you have the added complexity of global regulatory nexus, right, which we've been confronted with for a decade now, and at least in the US we feel like maybe there's some changes there that can be brighter, but that's a complicating factor. And also many of them really are community-driven projects. So it's not just like, can you build a piece of software and then get a bunch of customers to pay you for it, but a lot of these are developer layers, and so can you attract enough community of developers to build on top, and how does one measure the risks of that happening or not? How sticky are they? Do they exhibit network effects? Does the token capture economic value, or will the equity capture it, and if so, why? And maybe just one other piece of complexity I wanted to touch on is that when you do receive tokens from these projects, and they're on some kind of vesting schedule, and they become unvested, many of them are stakeable. Well, so do you stake your tokens on behalf of your LPs, and hopefully, because it produces economic return, but what's the risk associated with that? And what's the tax implications for tokens that come in as rewards? And does your LP like UTBI or not? And so like there's some complexity around the token piece too.
Yeah, no, sure, and that's why we rely on teams like David's to do that kind of that difficult stuff for us. Because for us, it's like a layer above nearly. It's like, and I'm not sure if this is a word or a term, but for us, it's all about fund maths, effectively. For us, it is really about, how do we get that underlying ownership in these projects? How can we source for like 0.5% or maybe 1%? And that for us is where, if you look at it, where for us, the asymmetry is so large, and you can get to such big outcomes, and especially because, and it's interesting, I think, since we've been doing this since the beginning of 18, the loss ratio is still incredibly low. And when you think about it in terms of risk reward, it's like the write-off ratio has been low, well, not low, but let's say single digits across, and that's from a fund of funds, right? I mean, that's 1,000+ projects. So very low write-off ratio if that filter works correctly, and the outcomes, as we've seen, can be in the multiple billions of dollars. So that's what we think is very interesting. But again, it's about that fund maths, because you can invest in a sort of a spray and pray fund, and you might get some nice, you can say, oh, I was in that top project. But if there are no dollars in it, then it's kind of pointless to us. So that for us is we look for managers that can give us that that opportunity to invest in those sweet spots. So going one level deeper, you touched on it a little bit, David. But when you look at the actual allocation, what do you look at?
Do you mean like what's our portfolio theory of how many companies? Yeah. Well, I guess the way I think about that is where are we on the risk reward curve when you're investing in a company? And so like my two favorite locations on the risk-reward curve for software companies are seed and Series A. And why is that? Seed stage deals, you're really making a team bet on a sort of market concept, right? Most seed stage deals have not written any software yet, really. They don't have a product in the market. But you have a thesis about like this team can deliver this really exciting innovation, but we don't have a lot of data on it yet. So you need a much larger number of bets, right, to play up because failure rate is very high there. So, typically I would think of like 35, 40, 45 companies in a fund, and depending on your check size, because you might see, well, much higher failure rate than you're seeing across funds. You could see 30, 40% failure rate. But Series A stage, typically you're investing when there is proof of concept, there's a product in the market, you're seeing some traction, but the moment after you invest is the steepest part. There's a knee in the curve of the value creation curve. So like right after you invest is the steepest part of growth, customer adoption, that then you'll see in the entire value creation curve. And so you're getting paid for the risk you're taking, and you have a little bit more data. So I feel like usually you hear venture people talk about third, a third, a third. Like a third of the companies will fail, a third will have like a middling outcome, a third will have fund returning outcome. And so I think that's appropriate around Series A. I feel a little bad talking so much. I'd really like to hear.
Yeah. We're gonna. Don't worry. You'll have nothing to say.
Thank you.
After this question, we're kind of going sort of sector by sector.
Fair enough.
Maybe one last thing, David, to stick with you anyway. Just to bring it home a little bit, sort of to where we are now. What's the thing you've noticed most in the last cycle? I mean, what are the lessons you've learned from that?
From the sort of FTX moment until now, we've had a huge amount of normalization in investing. So when I first started looking at investing in crypto, there was this, hey, you have to be comfortable investing in anons. Like literally the founders are not going to disclose their identities to you. You have absolutely no rights. You purchase tokens, but you have no equity claim on assets. You have no governance rights. There is no board. You can't fire the founders. These are anathema in traditional software venture capital, and you would never, as an LP, feel comfortable with a manager who had to submit to that lack of protections. Those have all been normalized away. Well, some people can still invest in anons. We do not. But you know who your teams are. You have governance structures in place. We're receiving rights that have claims on assets and intellectual property and things like this. So the normalization, I think, is. I'm sad to say we celebrate it, but we do. This is now like software VC. But what on the flip side of that is the TAMs are so unbelievably big here. These are instantaneous global markets, access to all capital in the entire world. So the asymmetric return profile, I think, is even higher than AI. It's higher than any other asset. And so I think in this cycle, in the event that we see continued positive momentum, my view is that crypto VC will have the highest returns in any category of VC, meaningfully so. So if you are an LP and you're investing in top decile, top quartile of venture-backed crypto VC, I think you'll have the highest returns in that category and anywhere else. Now I'm shutting up.
Yeah, no, that was it, I'm afraid. So you will be able to. I won't pester you anymore in that sense. Yeah, it's maybe just to add to that. It's a different way of saying it, but I think the structure of VC in this market. I mean, in effect, everything's a startup to begin with, but it gives you some staying power. It's and in the end, we all know how volatile crypto markets can be. To have that staying power is really, really crucial, and not being forced to sort of sell at the wrong time kind of thing. So, right, we will move on now, and maybe to move on to the more to the sort of operational challenges. Something you're clearly very well versed in that. If you're talking to a startup crypto fund, what are kind of the challenges they got to deal with? What are they running into?
Yeah, first of all, great points, David. So moving away from the fancy investment to the non-fancy, the operations and compliance and those kind of challenges. And there's a few things that pop up in almost every call that we go on with new fund managers. I'd say the first thing that they are mostly kind of deciding on is which jurisdiction to pick, right? There's a bunch of options. I mean, there's US, there's Cayman, BVI, there's other jurisdictions that are coming up. Australia, Singapore. So that's one of the first things that they have to decide as to which jurisdiction they want to go with. How do they want to structure the fund? Is it going to be a standalone, a master feeder? The AML rules kind of differ by jurisdiction. It really depends upon the investor's preference, but then there has to be a balance between what you choose. The other thing is finding the right partners, which makes your life easier, especially from an operations point of view. So you got to get the right, let's say, the auditors, the fund administrators, somebody who can do the taxes, and especially moving away from the TradFi to crypto, it's a little bit complex. The product in itself is complex. There could be a lot of investor issues. There's in-kind transactions, so that's something that you really have to find is the right balance of service providers. You got to look at fund administrators. You got to look at compliance firms, somebody who can handle the insurance and those kind of things. The next, I think, the challenge that I've seen the most is how to build the team, and how much to kind of leverage on your in-house team and how much you want to leverage on the service providers. Do you really want to be like a one-man shop, or do you want somebody to kind of handle the operations from an in-house perspective? So that's something that they want to kind of look at. Custody and asset security is very important. We've seen a lot of cases where the tokens are being stolen. There's irreplaceable losses that happens in crypto. So I think security and custody is kind of a very important thing to look into. So yeah, these are some of the major kind of items that we see most of the startup fund managers often struggle with.
And given your broader background, are there certain things that you think the crypto industry or the fund industry sometimes misses in that sense, which you're like, I see this a lot in our wider business, these guys aren't really looking at that?
I think the compliance part is something that people often ignore. That's a really important piece that fund managers should be looking at. You could leverage a lot to service providers, but I think you as a fund manager, you have to be like aware on, what filings need to be made. Are you regulatory compliant with all the SEC? If you are domiciled in the Cayman, are you really compliant with the Cayman Islands Monetary Authority, all the rules and regulations? So that's something that people tend to miss, which they often realize at a later point of time, and sometimes it causes problems. Yeah.
Yeah, maybe that's a libertarian beginnings that filter through a bit too much sometimes. Alan, maybe moving on with you, sort of on the shall we say the capital efficiency side, which I think is something that the crypto's got a fairly unique angle on. How do you feel managers should approach that capital efficiency side, and how do you sort of help them in that sense?
I think obviously when we're talking, like David earlier, that the liquidity profile of the underlying assets is quite different to traditional venture capital type. So you've got different ways of treating liquidity. The normal lockup for VC is kind of a 5 to 7 year to get your liquidity back. Now, some of these are faster, some of them might not be, some of them might be staked. So the underlying liquidity is quite different. And so we're finding a lot of opportunity with digital asset fund managers in how do they now structure their offering to match that, i.e. do they tokenize the fund where they've now got real-time pricing potentially of the underlying asset, real-time NAV, and does that give them optionality over instant redemption? which is one thing, or do they put an AMM in front of that and allow you to kind of have guaranteed liquidity for the purpose of then using that unit of a fund in the lending and borrowing platform? So you can start to now change the cost of capital. Instead of locking something up for 5 to 7 years, you could have the option of redeeming, you could have the option of putting it in the lending and borrowing market. So we're getting a lot of traction in first movers where they understand tokenization as a concept. How do they now leverage that for themselves in their own infrastructure? So how do they tokenize their own fund, and then what does that mean for attracting capital? And also with these funds are locked up, sometimes it's not necessarily digital native ones, but let's say it's a property fund where it's also highly illiquid. You can make your cost of capital, one, more attractive because you can offer secondary liquidity, which means you can probably bring more in at a better price, or you might not be fully deployed if you have redemptions, right? So you've got to have a bit of surplus cash to manage the redemptions, and so in some of these models you don't need that, so you can get a better return on that capital. So depending on where they are and the underlying asset, they've got some really interesting ideas, and we're working with them to effectively start to leverage the DeFi infrastructure that they kind of understand for their own native asset.
Yeah. And how do you notice that underlying LPs or investors in their funds react to that? I mean, is that market already there that people are looking for more liquidity in when buying whatever secondaries in these funds or secondary LPs things?
I think, and again, I'm just channeling the feedback we're getting from our fund managers, but generally the clients like the optionality of liquidity, right? Like that optionality is valuable, it has a price, and so it's desirable, not necessarily so desirable for the asset manager who has to manage that process, but definitely their view is that they can attract more capital generally if there's an optionality of liquidity that's, of secondary liquidity. So it's been driven by the customer more so than the asset manager. And I think because they're also trying to live the dream, if you will, that they understand the benefits of tokenization should give us better look through to the asset, what the underlying NAV is, what the real time is, and better liquidity outcomes that they feel kind of obliged to do that. But
Yeah. And how far off do you think we are when you think about, because now it's like tokenizing a fund or a real world asset as it were. How far away are we from just doing these things on chain?
We're already doing it. So
no, but sorry, I mean as in native. So you're not tokenizing something that is out there in the real world, but you're just raising the fund.
So the fund I'm referring to is actually a digital asset native fund, right? So it's a fund manager allocating to liquid digital assets, and therefore they already have look through and or even self custody in some options. So you can kind of, some of them are even pooling, the third party LP funds directly into like a vault. So we're getting all levels of that. So the fund manager effectively is just picking and allocating and not even necessarily being fully custodial in the capital sense. They just direct the trades by the mandate on chain.
Yeah. Well, fantastic. Okay. So moving on a little bit, we're going to move into the yield space. There are lots of different yield strategies. Can you maybe just start off by generally telling us, sort of in general, what the yields landscape is looking like at the moment?
DeFi yield is like the Wild West. There are like so many different opportunities, but it all comes with enormous risk. If you don't really look out for the risk, you're just going to lose all your capital. And at the same time, DeFi yield is also a superpower. Like our friend David mentioned, they're like people who can invest in companies. You can actually gain a lot of their shares, tokens, etc. But there are more economical ways how you can go contribute liquidity or like do some really not so capital intensive ways of interacting with protocols, and you can even have like a majority or like a good share of their token holdings. And so it's all about how you solve inefficiencies at the end of the day. Me personally, when I see like DeFi yield farming and then like making yield in like a whole bunch of different protocols, I see one specific thing, which is that what kind of inefficiencies or convenience does this platform offer? For instance, taking maybe even like, let me take Multiply as an example. What's the inefficiency that Multiply solves? There are so many decentralized exchanges in the world today. But then if you go and provide your liquidity inside these decentralized exchanges, there's a very high possibility that you get prone to a whole bunch of risks, like divergence risk, then impermanent loss, and like so many different other things. But then we make it super simplified, and we give you the convenience where you can just like put your liquidity with us, and then we manage all the things, and then we give you like incentives of like 20, 30% a year on stable coins, even after managing hundreds of millions of dollars. And there's also other examples. For example, if you also take Aave, which is like a lending and borrowing market, what convenience do they solve? They make it so easy for people to come with assets, and they make it so easy for borrowers to borrow their assets. And that's why you're actually able to make money from them. So at the end of the day, it's all about looking for people who are solving real inefficiencies in DeFi and deploying your assets there. Otherwise, please forget your capital.
Sorry, say that last bit?
Otherwise, please forget your capital.
Right, okay, yeah, no, fair point. So, you know, I mean, it's still something complicated for like a traditional investor base, right? I mean, you have loads of yield products in TradFi. I mean, the yields you'd probably find pretty pitiful given what you look at. What do you think is needed to get a broader group to look at yield in crypto? I suppose that's something I can ask the others as well. But you know, how do you get that broader base to look at this?
Yeah, if the question is about like, you know, TradFi, making it more accessible for TradFi?
Yeah, basically, not necessarily accessible, but how do you get a traditional investor to understand, you know, there's a huge opportunity here?
Yeah, it's all about, it all comes to the magic that DeFi offers. The magic is that it helps you access super complicated financial instruments in a super easy way. And for example, let's say like I'm from India and I want to access T-bills, which is in the US. Now that offers me 4-5%, and I want access to the best asset class in the world. Now, to me, like sitting in India to access this instrument, it's probably going to take me more than a month or two to come in and start getting the US dollars and also getting access into the T-bills, which in turn lets me make 4 or 5% a year. Now, if I'm going to do that through the crypto route, it's as simple as maybe a hour or 2 hours, and that's the beauty of crypto. It helps you make and access literally anything. It's just about it's so easy. It makes me wonder, people like, why just they don't do this thing?
That's kind of the question, right?
Yeah, I mean, but at the end of the day, it's also like, I think it's largely about people and the skepticism that comes with crypto, right? Every time people say crypto, people don't think of it as a reliable source of income. People see it as a way of making quick money. Every single person, in fact, many of the audience here, I'm sorry, but then we're all here just to make some good money, and people are here because of 2 things, and it's pretty true. We are here either if it's going to be for greed, we are here either if it's going to be for fear. And I think that's one of the main reasons that has also united us today, and that's also going to be the main reason that's going to be uniting us in the future too. And I feel personally that's what is going to happen. In fact, we are like working with like a whole bunch of institutions like Paxos and like everyone offering yield on instruments like gold. And before, it was super hard to convince people to tokenize instruments like gold and bring it on chain. For instance, it took us 10 years to actually bring on board $500 million of gold. But guess how much time it took to bring like $100 million of gold out of that? It literally took 8 weeks. And that's because now we have a real way to go and use gold in DeFi, which in turn gives them 9 or 10% of APY each and every single year, which makes it all the more interesting for people to come in and start using it. And I think this greed will be the driving factor as to onboarding more users, and would also be the reason why we would see a lot of TradFi people coming onto the space.
Got it. Well, we'll see how long that takes. Maybe some of the others. Would you like to comment on that? And I suppose specifically, look, I'm trying to dress it up, but it's like a question that I'm sure you've been asked many times. You know, what is needed to get a traditional? You know, we're on the investor panels here. What is needed to get more traditional investors on board with this space? You know, how do they look through all that noise?
I think we're just in the middle of it right now. Like if you stare at the data, it's happening. The first major catalyst this year is likely to be massive stablecoin increase in usage and volume. You know, I think we go from $223 billion of stables to $1 trillion by the end of the year. That's just the movement of mostly, you know, fiat currency on digital rails for much cheaper, much faster, much more transparent, globally accessible. Banks will support it, payment companies support it, business to business, business to consumer to consumer. This is happening right now, and the wave is upon us, and that drives usage on chain, which drives fees or activity or number of wallets and more wealth on chain, which leads to the DeFi opportunity. Well, if you are going to hold digital assets, you might as well earn yield from them, and what's the safe way to do so, or commensurate with your risk level. Like this is the catalyst happening this year. And it's just through, you know, 5x the amount of payment volume or usage, and then the fee generation on the networks. You know, Ethereum generated $1.7 billion of fees the last 12 months. It peaked at $6 billion. I mean, these are companies with 30 or 40 or 50 people in them, effectively generating, you know, hundreds of millions of dollars or billions of dollars of fees. So we're just going to see massive value creation because of like payment activity on chain, and that's going to lead to the greed. Like I want a part of that.
Yep. No, we're anecdotally we're noticing the same thing, by the way. Alan, would you like to comment on that?
Yep. No, I think one of the big things that would improve investor confidence is I think there needs to be more and more transparent reporting to the investors. Like you know, you need to report timely, accurately to the investors, and a large part of it depends on you know, the auditors, fund administrators who are kind of reporting. But as a fund manager, you need to be like pretty open with the investor as to what's going on. You know, that's something that that's really important. And we are already seeing a lot of the TradFi people. They are kind of interested in crypto. We are, you know, talking about tokenized funds. You know, that's another way of bringing in more kind of TradFi capital into the crypto world. You know, the underlying product could be money market, it could be real estate, you know, credit products. But bringing that on chain would kind of flow in more and more capital into this space. And I think you know, there needs to be more regulatory clarity, which is kind of happening now. So that would definitely bring in more confidence into this space.
Yeah, just finally, I think from my perspective, it's when the blockchain fades to the database. So we shouldn't be thinking about some of the tech challenges and the tech risk that we have today. I think stablecoins will be a good example. Once everyone's got a wallet that's got an asset in it, whether it's a stablecoin or something else, you've then got kind of the end user infrastructure that's required for us to buy anything, and we won't care what database it's on. It'll just be accessed like we access any other financial service. And I think that's when, and, you know, I think David said it earlier, it's a global liquid 24/7 market of everything. So it's just going to be the new capital market, and I think that'll just tip based on more people having more wallets with more assets in them.
Yeah, I mean, you know, if Libra went ahead,
yeah,
and we all had it in our WhatsApp, we wouldn't be having this conversation. But so it's like that. But anyway, on that note, we're up for time. I'd like to thank all the panelists very much, and I'm going to pass it over to the Blockworks team, I think.
Thank you.
Yeah.
Thanks. Thank you.
All righty. Next up here, we are talking about weathering cycles in high growth tech markets. Obviously, crypto is one of those that is included in that. And we're going to be joined by Bill Hardit of Abra and Shervin Pishavar of Sherpa Capital. So give a warm welcome to them both. This is going to be a great one. Welcome.
All right, good afternoon. So I think we have like 20 minutes, so why don't we do like a rapid fire? Let's get right into it. Let's see.
Hello, everyone.
Yeah, Bill Barheit from Abra and
Shervin Pishavar from Edison.
yeah. So we're going to segue this into crypto, but before we do, let's pick three. Let's pick three CEOs. Who are the three iconic CEOs that you've worked with in the last, let's say, 10 years?
Well, I mean, as a kind of thesis of what I do, I look for the smartest founders that I can possibly find, and I've been lucky to have been able to back some great entrepreneurs. Probably the top three for me are Elon Musk, Travis Kalanick from Uber, and Brian Chesky from Airbnb. So I backed all three of those probably 15 years ago, and it was a blessing to be able to work with them, become friends with them, and there's a lot of like commonality in and some differences in all of their approaches and their kind of mental models and how they executed. But there's no question that they created not just value in terms of the companies that they created, but they sent ripples into the world. They fundamentally changed our world. If you compare it to like 2010 versus 2025, each one of those companies has fundamentally changed many aspects of our lives. If you remember Uber, before Uber, what it was like to land in a city and not be able to push a button and get a car on demand and deal with the 333 taxi numbers that you used to have to call, and the frustration and the horrible customer experience that you had to deal with. Just a fundamental change in our daily lives. And part of what I look for in my investments, because my day job is a venture capitalist, I've been lucky to invest in great entrepreneurs and great companies and great teams, and have returned something like $7 billion in value from early stage investments, 88% IRR. Scares me because it's hard to keep up with that. So I might just retire. But it's an exciting time to be investing and looking for the future Elons, the future Travises, and the future Brians. I think in terms of not just their intelligence, probably in Elon's case and Travis and Brian, the number one trait that I noticed with them was fearlessness. They weren't afraid of anything. I mean, it was just, I saw it viscerally on a daily basis, and I think all of us have seen it in many of those examples. There is a courage and a resilience that exists and a chip on their shoulders. And these are kind of signals that I look for in great founders, is that the chip on the shoulder, has many different sources of where that can come from in one's life. But if you don't have it, you don't have something to prove to yourself or to the world, it's hard to become as courageous as they are. And I think it's a source of courage And I could give many examples of, Travis. One time we were in a hotel room together in North Carolina, and it was the RNC. So we went to the DNC and RNC to launch Uber back in the day. This is like 2012. And we had just launched Uber Taxi. So we didn't have taxis on Uber. And the taxi commissioner had told Travis that he can do that. And he worked really hard with the team to launch it in time. And it had just launched. And obviously, because we were fighting, the taxi cartels and the corrupt city councils and mayors of the world, I called them the taxi mafia. And we had death threats and all kinds of stuff going on back in the day. They got to the taxi commissioner. So the call came in while we were in the hotel, and so I'm listening to this call, and Travis just tears the taxi commissioner apart, and he was so upset. He was like, "You gave me your word," and that's another thing is these guys, when they give their word, it actually means something, right? And so they're very principled and these types of founders. And so in that case, I was just kind of watching it in awe, because most people in a taxi commissioner who could just block you from business immediately, block everything you're doing with one signature, most people would be demure and, diplomatic and, oh, I understand, like, okay, well, maybe we can get the taxi thing back up, what do we have to do? It was none of that. It was just like, no, you promised me, you said we can do this. And I looked at that and I was like, this is why I backed this guy, because it worked, and it also worked. That kind of courage actually works in our world.
So I think, and maybe people in crypto who've been in, I've been in 10 years and doing this, actually 15 since the beginning of Bitcoin. I think what we can relate to is that what people hear, people on the outside might call crazy, right? Yeah. We simply call conviction and courage, right? Because people don't understand why a Michael Saylor would have so much conviction for what he's doing, or why, Travis would have so much conviction for what he's doing, because they haven't spent hundreds or thousands of hours working on exactly the same problem and given their entire life to the same problem and failed 6 other ways trying to solve the same problem. So I think that there's on the outside, what appears to be like a crazy element, which really isn't crazy when you're on the inside. It's just conviction and courage. Is that?
Yes. Well, courage can look crazy, especially when people don't understand why you're being courageous about something. And a lot of times these types of founders are time travelers. They're seeing something in the future that we can't see, and so they're drawn to that future, and they have the courage and conviction to get there no matter what. And the other thing that all of those founders came close to death. They stared death in the face. Elon was sleeping on the couch in his friends' houses when I met him. It was like 2008. Vantage, which is, I'm a venture capitalist, but I hate VCs. I'm a self-loafing venture capitalist. I think they can be absolutely horrible. You have to be very careful taking anyone's money. And because they can destroy your company. Look at what happened to Travis. Look what happened to Elon. Elon almost lost Tesla because Vantage partners decided they wanted to go after him, similar to what Gurley did at Uber and almost destroyed Uber, and fired one of the greatest entrepreneurs of our time. Idiot. Steve Jobs, same thing. There is venture capitalists are typically the opposite of what I'm describing of courageous, right? And so it's extremely important to be careful, who you take your money from, and look at their track record and their behavior with other founders, especially when things get tough. When things get tough, you're supposed to be courageous and support the courage of an entrepreneur who's facing death in the face. They did one of the history's worst, debacles as a venture capitalist. They sold their shares after trying to get rid of Elon for like 33 cents a share after all the stock splits in 2008. They would have made $100 billion, right? Yeah, thank you for the laughter. You're awesome. Because it is funny. And, you know, the same thing with Uber. If I know with conviction Uber would be a Tesla-sized company if Bill Gurley had not fired Travis Kalanick. Just an idiotic move at the peak of when Travis was just taking over the world. He was doing I don't know, you were at the conference, you spoke with Peter Diamandis at his conference last week, and I saw what he said, and it breaks my heart because Travis had all of the vision. He had everything right. He had the thesis right. He told me in 2011 when there were just a couple thousand cars in the streets of Dublin, the night that I gave him the term sheet, and he said, I want to replace car ownership. That's what I want to do. It's not about taxis and black cars. I want to replace car ownership. And he had the vision, and he was doing self-driving way before anyone else. He had it ahead of everyone. And now Waymo's all over the streets. Everyone's taking Waymo in the cities that it's launched. It's taking over all the market share. You know, Tesla's launching robotaxis. So that's another example. Benchmark owned, what, 14% of Uber at the time? If it was $1 trillion company, they would have made over $100 billion. They completely destroyed that. Apple, they got rid of Steve Jobs. What is it? 3 trillion, you know, and sent him into the wilderness for years. We lost, think about that. If Steve Jobs had actually stayed at Apple from 1989, 88, whenever they fired him, the world would have accelerated. We had to wait until he came back in order for him to have the platform again and do what he did at Apple with the iPod, with the iPhone, with the iPad, and everything else that's happened since. Yep. So those are some examples of courage and the lack of courage and the costs of those two things.
Yeah, so people talk about grit for entrepreneurs, right, which is something that everybody in our space understands now. If you've been in the space more than 4 years, but I guess grit for the right investors is equally important, right? Because you're weathering a storm with the same people around the table, and you really are in the same boat at that point, right?
I never thought of this analogy, but because VCs mostly ignored crypto, you guys were so lucky that you did not have VCs.
Don't you all feel
you're like so lucky,
unbelievably lucky after the last 4 years?
100%.
Yeah.
And then, do you know who acted as the VC that tried to destroy you? Gensler. Gensler was Bill Gurley. Like SEC was the VC of the crypto space. Right. That's what happened.
Is there any press in this room? This is, yeah, okay.
I just realized that. I never had that thought, but it's absolutely right.
Yeah.
Yeah.
Well, maybe Warren promised him Treasury Secretary as well. So, I don't know. All right, so greener pastures, right? So you've also, you know, made a decision to obviously get into the crypto world, although I think you've made some investments in crypto over the years. But you know, we're thrilled to have you join Abra as co-chair with myself. What are your, like, what excites you? I mean, I could give my opinion, but are there a couple of themes that excite you now about our world, or, you know, like, you know, you obviously have investment themes that, in addition to smart VCs, smart entrepreneurs, but, you know, what is exciting for you right now?
Well, I mean, I joined Abra as co-chairman because of you. I think you're one of the smartest people that I.
Do we have Abra staff? Oh yeah, over here. You taking notes?
No, but I mean it. Like,
right
I don't join a lot of companies, and I'm excited about what you're working on. I think also the resilience that you and your team have shown, you know, with the SEC going after you and surviving that and now thriving is just gonna, you know, the timing is so incredible for Abra. So I'm excited about everything you're working on, and I'd love for you to also just touch on your vision and where you want to take Abra.
Yeah, I mean, I think my whole career has been mapping Moore's law to where it's all going next, right? I mean, I've been very good at that from the other side of the table, right? VCs were good at that in the 90s and 2000s, and I made a career of doing the same thing, whether it was early internet, my Netscape days, or building mobile apps, or crypto, or whatever's next. Although I think this is it for me. I think the next 25 years is going to be rebuilding the banking system. So I fundamentally believe that where we've progressed in terms of compute power and AI integration, I think that the entire banking system needs to be decentralized from the ground up. I think it needs to go away. I think Chase is blockbuster. And I think I'm sorry if there's anybody here from Chase, but I used to say this to my friends at Blockbuster in the 90s as well. I think that the biggest banks in the world in 20 years are going to be 100% based on DeFi rails. And I don't know if it's going to take 5 years or 20 years for $100 billion companies to emerge that leverage DeFi. So I'll hedge and say 20, but I actually think it's going to be faster than that. And so our goal is simply to facilitate that and make it happen faster, right? Whether it's yield, lending, institutionalization, tokenization of real-world assets. And by the way, everybody here talks about tokenization of real-world assets. Does anybody actually understand why you would want to tokenize real-world assets in the first place? It comes down to fungibility, right? So the ability to create a decentralized marketplace where you have fungibility between two assets that normally are not easily fungible, right? I used to work when I was a kid, I worked in private placements at Goldman before I got sane and went back to tech. And private placements in those days would take 4 months to close. And so now we can tokenize assets, and you can borrow against real estate using Bitcoin. You can trade Bitcoin for stocks, and that's all basically because we're going to have these fungible real-world assets. Why shouldn't I be able to borrow against my Abra shares or my Apple shares or my Coinbase shares the same way that you can borrow against Bitcoin using Abra today? So I think this whole idea of decentralization is definitely the future of banking, but it's going to require usability, meaning it needs to be accessible to consumers, businesses, in a way where they don't have to understand, like they don't have to understand what a money market, how it works. They don't want to understand the innards of how a decentralized lending marketplace works. And so it's going to behoove all of us to put the right user experiences and service layers on top of that take advantage of at least the first generation of lending and yield and trading capabilities that lead us into what I think is going to be just a fully decentralized banking system. And that's our vision. I came for the decentralization, as we say, and I'm staying for the decentralization. It started with Bitcoin, and it's evolved, since then. But so we have 2 minutes. So do you have any other investment themes? I have my own thoughts about AI. So obviously, everybody's talking about AI now. I think the intersection of AI and crypto is going to be massive, like the second coming of smart contracts. Are there other aspects of AI that you're looking at, like data centers or other things in that area?
Yeah. So I've been doing investments in AI and quantum computing for well over 10, 12 years. I think AI is getting all the attention, but quantum computing is kind of like the hidden sibling in the basement, and it's starting to graduate. So I've been lucky to back a few quantum companies that I believe in. One is IonQ, Psi Quantum, and the other is D-Wave, which we took public with a SPAC that I started called DPCM with Emil Michael, who's the new Undersecretary of Defense, and for R&D, and Eric Schmidt. D-Wave is doing quite well. And quantum took 20 years of R&D to get to where it is today. I've been tracking it since my Berkeley days. And it's going to accelerate our compute capabilities in a way that is, hard for the human brain to really imagine. But Psi Quantum, for example, is going to get to 1 million qubits using photonics, light. And I've been in the foundry, I've seen it. by 2028, we're at like 5,000 qubits or less. And so a million qubits is basically, the way I describe it is it's like the mind of God. And so all of the things that we have with AGI and GPUs and everything that's happening is with our current compute capabilities. We're about to basically take that to the moon. And so I call it kind of quantum AI convergence. And when that happens, all the acceleration that we already feel, that feels historic, where every day is a week and a week is a month and a month is a year, that we can see it viscerally, we can feel it every week. Something's happening, whether it's DeepSeek or some other massive news or development, you know, and so the idea of also encryption is under threat. So you know, because at those levels of compute, it's going to be you're going to be able to crack
instantaneously.
Yeah.
Yeah. So
just the final thing on that is like just think about in a world where you can't encrypt things, then we're going to live in a radically transparent world where it's very difficult to keep secrets for governments, intelligence. It'll have obviously implications for crypto. And so there's massive amounts of disruption that are going to happen.
That's right.
And I think that's also an opportunity.
Yeah, I would say for institutions, the way I would look at it, maybe this is a parting thought for something you got to prepare for, is that remember the Millennium Bug, 1999? Everybody thought every computer system was going to fail in 6 months. Well, this is more real than that. I would say we need a moonshot level investment in kind of rethinking quantum readying everything, right? And it's going to take a decade, but as a former cryptographer, the good news is I can tell you that there's a lot of work being done in kind of quantum ready algorithms for a lot of this stuff, and so a lot of the base layer stuff that we're all using is definitely going to have to be upgraded. But the good news is, so is everything else, right? Like crypto is like, it's definitely on the list, but so is your banking system, your government systems, your everything, right? So yeah, all of it. So as quantum goes, so goes the rest of the universe, including AI. So maybe we'll leave it there since we're getting the evil eye.
Yeah, just to scare everyone at the end.
We'll get back to work, so it's all good.
All right.
Yeah.
Thanks,
everyone. Thanks, Irvin.
All right. Hopefully we have some press in this room because Shervin is dropping some absolute heater one-liners there. I love it. Okay, super excited for this next panel here. We got a whole bunch of great folk talking about the next wave of institutional crypto products. So we got James Seyfert from Bloomberg, who I view as ETF GCR here. We got John Patrick Mullen from Mantra. We got Robert Leshner from Superstate. We got Jeff Park, who I view as options and derivatives GCR. And finally, we got Amber Subaran from Kaiko. So give it up for them. This is going to be a great panel.
All right, while we all get seated, I'm going to let each one of the panelists introduce themselves, tell a little about their firms and what they do. Briefly, I work at Bloomberg Intelligence. I write research about the asset management industry and do a lot of coverage of research of anything that overlaps between TradFi and DeFi in the asset management space. But let's start by going down the line. Robert.
Yeah, I'm Robert Leshner. I'm the CEO of Superstate. We're an asset management firm that's tokenizing the products we create. I'm more well known as the host of the Chopping Block podcast, if anyone in crypto listens to that. And I formerly founded Compound.
Hi, I'm Amber Soubiran. I'm the CEO of Kaiko. Kaiko is a market data and analytics and index company in the crypto space.
Everyone, I'm John Patrick Mullen, or JP, CEO and co-founder of Mantra. We're a purpose-built, real-world asset-focused Layer 1 blockchain. Recently received unique licensing from VARA, which is the Dubai virtual asset regulator for brokerage, exchange, and asset management, all natively on-chain, DeFi specific. And we're one of the largest real-world asset tokens by market cap.
Amazing. Hi, everybody. I'm Jeff Park. I'm the head of alpha strategies at Bitwise Asset Management. Most of you guys will know us for having the Bitcoin spot ETF, but we're also famous for having the world's largest crypto index fund, which has been around now for a long time. We are 7 years old. We have about 100 people. We manage over $10 billion in assets today. which is a remarkable thing as a crypto company here in the United States.
Yeah, so I'm a data guy. Abra obviously focuses a lot on data. Jeff is primarily funds and ETFs. And then we have Robert and JP that are going to talk about the real world asset tokenization side of things. So we got a lot of different avenues to cover, and I apologize in advance if it seems sporadic, but hopefully we'll keep it lively. Why don't we start with Robert? There was some big news with Superstate in the last day. Let's get kicked off with like the one thing that tokenization arguably has found product market fit. The one thing that, in my mind, crypto has found product market fit, aside from Bitcoin, digital store of value, is stablecoins, is tokenization of money and treasury assets. Why don't you get into what you guys are doing and what the news was?
Yeah, absolutely. So the first major, real-world asset that got popular on blockchains were stablecoins. People said, "Oh, let's take $1 from off-chain and put it on-chain in the form of a token." Super popular. There's like $200 billion of stablecoins. Everybody loves them. The second, successful, direction of RWAs is definitely tokenized treasuries. After stablecoins, it's like, well, if you can take $1 and put it on-chain, what about taking a super safe, short-term interest rate producing asset and put it on chain? And so tokenized T-bills or money market funds are really the next category that's beginning to grow. And the growth is pretty much in line with the velocity that stablecoins grew. And I think in a couple years, the market will be the size of stablecoins potentially. But, Superstate's first major project is a tokenized T-bill fund, and it's designed for crypto native customers, being protocols and DAOs and foundations and hedge funds that are doing DeFi things and, the most, on-chain investors possible. And so yesterday it was announced that MakerDAO / Sky in their rebrand, one of the, original DeFi protocols that creates a stablecoin, is going to be using Superstate alongside BlackRock and Centrifuge to manage the assets underlying their stablecoin. So their stablecoin is backed by other stablecoins like USDC. It's also backed by, crypto native collateral. And this is an example of one of the largest assets in crypto moving its operations into RWAs, moving the back end, of their stablecoin into a tokenized T-bill. And so they're allocating $1 billion. It's pretty exciting. And over the next couple months and years, it's possible that they're, a $5–10 billion investor in RWAs.
Yeah, and let's keep this conversational. So if anyone has anything to add or chime in, feel free to do it. But I guess you kind of talked about the real use of tokenization so far at this point seems to be like the capital is already on chain and people are looking for similar types of instruments in TradFi. Like, what is the catalyst to, I guess, bring people on chain to actually use these things? Like, I don't know, JP, what is your thought here? Like, right now, it's like a chicken or the egg problem. Like, you're building this stuff, the people on chain want it, but like, how do you actually bring people from off chain on chain?
Sure. So we kind of see it on like this spectrum of permissionless versus permissioned, and that's why we've created a blockchain that has a permissionless layer, but effectively has this area where you can actually issue permissioned assets to onboarded KYC accredited investors who are actually the people who want to buy these type of products. If you look at the permissionless side of things, I think mainly of on-chain DeFi users. They don't necessarily want to do a rigorous onboarding experience multiple times to interact with products, and many times they're not actually that actively looking for a treasury product. Maybe they want like a meme coin today, which is fine. But the institutional guys do want these yield-bearing products. That being said, the on-chain user experience today is still very clunky, and in many instances, like the economics actually aren't that attractive as well, because it's like almost like this fees on fees model, right? So one of the ways that we've seen some success is effectively, by managing subsidies and managing kind of economic incentives, you can actually reduce the costs of issuers to come on chain. So that's one thing. And at the same time, subsidize yield as well. So maybe just give a little bit of additional, basis points just to make sure that people want to actually come on chain, with the understanding that eventually that will wean off, and eventually the on-chain, version of these type of assets will just be more programmable, more usable, more functional. But that's not really the case right now. So again, where we've seen some success is literally going, almost like person by person, through our network and actually teaching them how to come on-chain for the first time. So it's actually not really going after the existing on-chain capital, but actually this net new capital coming in, which I think is going to be a big benefit to the space, because oftentimes the people that we're interacting with buying a tokenized money market product or tokenized private credit fund, they're already buying this stuff in the real world, and you got to incentivize them to come on-chain for the first time. So you figure out what those incentive structures are. But you literally have to go and teach them how to set up a wallet, how to manage keys, and all these different things. So as that experience improves, I think we're going to see this start coming and snowballing, which will be great. But it really is like a kind of a rigorous distribution model that is not all that sexy and attractive, but it's the way that it's going to start moving the needle.
Yeah, so sticking with tokenization, I feel like the more I dive in, the more it seems like it's just we're taking the back-end plumbing of the TradFi infrastructure and replacing it with blockchain, which isn't as sexy as just saying tokenization. It's like we're just kind of replacing things.
Not that sexy, to be honest.
Yeah. So, I guess, what is the big differentiation aside from potentially down the line being more cost-effective, more efficient, things like that? I mean, we see a lot of exchanges and different platforms are going to 24/7 trading in that sense, but what are the downstream effects and benefits of actually doing tokenization? And this is open to the floor, but we'll start with JP.
Sure, maybe just super quick. I mean, if you look at some of the bigger asset managers that have started tokenizing money market products today, I feel like it's been a little bit of almost like a pay-to-play model where chains and protocols will be like, okay, we're going to buy a few bucks of your money market product to put it on our chain so we get a nice marketing spin and nice announcement. But if there's actually nothing happening with it, kind of what's the point, right? It just sits there in a tokenized form as a maybe a treasury diversification tool, fine. But when you actually start having these things become composable and more functional within DeFi, using them as collateral, using them in other different types of DeFi primitives, that's when it starts becoming quite interesting, but it's not there yet. Right? That's a future promise. And I think the on-chain user experience improving, the ability to have regulated secondary market venues and secondary or even just regulated applications in general was going to start unlocking these different use cases. But again, it's bit by bit. And I feel like RWA or tokenization is definitely a multi-cycle thing, right? So we're still very, very early on the permissionless side of things.
Jeff, go ahead.
Yeah, I agree with this. And in many ways, ETFs also in the theme of tokenization are actually more similar than different. What I mean by this is actually ETFs represent maybe one of the more first primitive version of what tokenization as a project is, right? If you think about what ETFs do, it's essentially one of the capital market's greatest invention in what I call liquidity transformation, right? Both on the underlying assets that historically may not have had liquidity being brought on by the ETF, then becoming a substitute for those flows. But secondarily, as collateral assets, right? These ETFs then become collateral in which margin can be provided in ways that bring additional liquidity. That's incredible. And tokenization also provides a lot of ways to imagine this on-chain with different utilities, but there's a lot of similarities here. So this is something I think about all the time. Bitwise also thinks about all the time in terms of where is the movement of tokenization and how do ETFs play a role into it. And if you ask me, what is the one fundamental thing that looks really different between ETFs and the way we talk about RWAs? My personal opinion is custody. There's an element of the custody model that really changes in the ways we think about RWAs, which is so entrenched in the traditional system as we know it. As ETF players, the ways in which the custodians touch every aspect of the clearing, to the settlement, to the pricing, that core piece can change with RWAs. And I think that's actually, to your point, maybe not the sexiest thing. Custodians are meant not to be the sexiest thing, but that is kind of the greatest room for, I think, innovations and where institutional interest will take place. They're going to look at that as an opportunity. And we're starting with the low-hanging fruits of money market funds, but my personal belief is that real inflection point when institutions are going to start coming into the way you are describing RWA that we're preaching about it has to bring a product that is so different than what we know in TradFi. These money market funds are great, but to be honest, all of us probably prefer to just buy our money market funds in Fidelity the way we know it, right? The reality is crypto can do much more interesting things on the long tail of assets, the projects you're working on, where there historically hasn't been a liquidity transformation in the way that I was able to describe. And that's the opportunity. And I think that's the product market fit that's really going to bring institutional interest very deeply.
No, I fully agree that the big opportunity when it comes to tokenization and RWA is operational efficiencies and what existing problems you can solve. And And I don't think that the low-hanging fruit is things that already work very well. It's clearly about fixing things that are not, fully operational yet. And so, private credit is one of them. And then the first thing is obviously bringing on operational efficiencies for things that do not have that natively in TradFi. But then the second thing is not creating a tokenized version of something just for the sake of adding a tech layer to the thing. It needs to enable some applications then on-chain, and whether that's using the tokenized thing as collateral to enable, lending or any other traditional application, that actually makes a lot of sense. And when you think about the more illiquid parts of the lending world, typically back to private credit, if you can then use that as collateral and have that much more mobile and much more kind of easy to transfer across entities, that is one of the things that is interesting from that angle.
Do you have any thoughts, Robert, before I chime in?
Let's move to the next question and keep it fresh.
Okay. Well, I just want to say something real quick. I like that you called it an invention, the ETFs or technology. I've actually argued, we have sister podcasts, Robert and I argued with Laura Shin about this because we call the ETF technology an invention, and a lot of people are like, how can you call it that? But it really is. And one of the main things I hear about, it reminds me of talking about ETFs from like 5 or 7 years ago, or 10 years ago even. People are like talking about tokenization, like you can't make things liquid that aren't liquid, but actually you can, and ETFs do that all the time. It's constant. Like the S&P 500 ETF is more liquid than all of its underlying. And yes, at the end of the day, if there's like something breaks, the liquidity of the ETF is going to fall to the level of the underlying assets that it holds. And I feel like that's kind of the same thing as like tokenization. But at the end of the day, when things are operating smoothly, you can add liquidity. And there's like this theory out there that we had a lot of hedge fund managers years and years ago saying that ETFs were going to blow up the traditional financial system because they're making things liquid. It's like, we call it the Jurassic Park problem. You're taking, dinosaurs and putting them in like computers today. But like, I think tokenization will be the same way. And I think the analogy between ETFs and tokenization makes a ton of sense to me personally. But Jeff, you were saying the real benefit here is going to be things that like, aren't working well in the TradFi world, but you didn't, like, what's an example of something you think makes the most sense that would be tokenized? Because you kind of hinted at it, but you never actually said anything.
Yeah, totally. And by the way, it's not to actually discount all the great work that is being on the very basic of stablecoins and T-bills. These are actually foundational things we need. So actually, I give a lot of praise for the sacrifice that is being made by the pursuance of that business, because these are necessary rails we have to build. But the adoption part will come when the product is interesting, in my opinion. And the product that I think that is interesting is the kinds of alternative assets that investors want to access today, but the traditional system makes it very challenging. So private credit is a really good example. Private credit is a catch-all phrase as an asset class of something that can be private for many different reasons, right? It could be middle market lending, it could be asset-backed securities, it could be esoteric litigation financing. Whatever it is, it all becomes classified as private credit. But the reality is it's not really meaningful in that definition. And so each of these things can be explored more thoughtfully if you thought there was liquidity at the underlying level that would match differently than the investment wrapper itself. These private credit funds are just locked up vehicles of underlying assets for which you don't know what the liquidity is. So one great use case, and this is something we did at Bitwise very recently, is that we partnered with Maple Finance, which is one of the oldest DeFi protocols that are permitting lending operations on Bitcoin collateral with stablecoins. And so the idea of over-collateralized Bitcoin loans, right? This is as simple as like the birth of civilization. You have assets and you want to borrow against it. And you can do that on-chain with Bitcoin in ways that is called private credit because it's an asset-backed loan, but there's nothing illiquid about what that loan is worth because the underlying collateral is Bitcoin, and that is extremely liquid. And so there's no reason this should be private credit, but it is. And so that as a construct in which tokenization can bring liquidity that it can deserve, I think is kind of interesting pockets of opportunities and the ones that we'd like to keep an eye on and focus and bring institutional adoption for.
Robert, you look like you wanted to say something there. Do you want to add anything? Or?
No, I was just going to tell Jeff to leak all the alpha about what Superstate should tokenize.
Yes.
Yeah, be really specific. Which funds?
I actually will, because the other thing that I pay attention very closely is Superstate, by the way. This is full fact. I would admit it. There are things that also, like Superstate is doing, where they're bringing investable opportunities on like trades, right? Like things that you give hedge fund managers and pay fees to do, that doesn't really require that much active management, that actually could be made into something more investable in a tokenized format. I actually think this is a big thesis as well.
Amber, let's get into what Keiko does. You're dealing with a lot of institutions. I believe you even deal with my employer, Bloomberg. Can you talk about like what it's like, the differences between working with data in the TradFi world and how you're taking like the DeFi data and plugging in the backend APIs, things like that. Just give us a little insight into like the nuances and differences between DeFi data and TradFi data.
Absolutely. So for me, when it comes to crypto data, there's going to be two phases, and maybe we just move back away from tokenization back into crypto. The first phase of kind of institutions looking at crypto was to say this is a new investable asset class, and so we need market data like we do for any traditional asset class. So that was and still is kind of the main product that we offer, is literally market data, APIs, and plumbing to enable access to market data on crypto as an investable asset class, and that is like order books and individual tick trades and everything that happens across every market, including DEXs and lending and borrowing protocol. All the financial market information that is kind of slightly more commoditized, but somebody needs to do it, and somebody needs to do it well, and we power about a couple of hundred clients globally with those market data feeds. That's part one, and we are not doing any kind of front-end stuff, so we're on the plumbing side, powering terminals such as Bloomberg, indeed. And then what I think, and it takes us back to tokenization, is that if you believe in an increasingly on-chain world, especially an on-chain world that enables capital markets application, you are going to be in a world where the execution of financial contract will be much more disintermediated. That's the whole point, right? Making kind of the whole operational workflow more efficient and more disintermediated. But thereby, it means that the data that you input into the smart contract representing your financial contract is increasingly critical. Because there's no more failovers. You're not going to have middle office calling you and say, oh, I disagree with that margin call or that liquidation or coupon payment or whatever. It's just, the whole workflow is automated within the contract. And thereby, data becomes even more critical in a tokenized world. And for all of the tokenized securities we've mentioned, there is today no native on-chain markets where price formation happens, meaning that if you want to enable financial applications using those tokenized securities on-chain, you actually need to get the valuation data of those assets from not the blockchain and provide it on-chain to enable financial applications. So that's kind of the world. I think we are at the beginning of an inflection point. Obviously, the first step is tokenizing assets. The immediate next steps is to say, now that those assets are tokenized, what can we enable? And that will be data hungry in the same way that TradFi today is data hungry, right? It's just a different network, different platform, different infrastructure, but still requires calculation agents, nav calcs, option pricing, and all these prices do not live on chain natively. So that's also some of the things we're looking at within the tokenization angle, is the whole data application layer, which involves reading from the blockchain and offboarding that data through an API to people who need to consume it. It involves the whole data workflow and the whole data capabilities, and then also the ability to enable the execution of smart contracts with data that needs to be accountable and accurate, and there's no rollback.
So what you guys are doing, and what I feel like a lot of institutions are doing, including the likes of BlackRock, Wisdom Tree, Franklin Templeton, and what JP and Robert are doing, there's kind of seems to be this, you're creating bridges that go both directions. Like I think of the ETF as a bridge. You're taking a DeFi asset, put it in a TradFi rail. In the case of the money markets and some other assets, which I would love to get into, the real estate that JP was talking about, you're taking that on the TradFi real world and putting it on DeFi. But like for the most part, all the stuff I've seen, it's like dual track. We were talking about this a little bit before. You're still doing things the old way. You're still keeping things with like a clearing agent, a transfer agent, and things are operating on the blockchain side of things. So I guess I'll start with you, JP. Like, one, why is it being done that way right now? Two, are we going to get to a point where everything is actually going to be taken care of on the blockchain? And like, is there any risks or anything that you're worried about with how things are working?
Yeah, sure, great question. I mean, I think, there's clearly not a whole lot of like institutional people on chain today actively in permissionless environments. So that's one of the big hurdles that we have to overcome as an industry in general. There's a bigger compliance risk when you get into this like permissionless world, right? So that's a challenge. We're seeing within the real estate use case, so just some context, we're doing a lot of stuff in the UAE. We've been tokenizing a number of different real estate assets. We have a big partnership with Damak Group, which is the largest private property developer in the Middle East. We actually announced about $1 billion minimum transaction that we're doing with them, but instead of just actually tokenizing like an SPV or wrapper for a real estate asset, we're actually collaborating with them to tokenize the underlying title natively. And actually today, the Dubai Land Department, which is effectively the Dubai Land Registrar, the Dubai government, came out and said that they're actually working to tokenize titles, which is pretty exciting stuff. Obviously, they're doing it with us as well. They didn't put that announcement, though. little alpha. But anyway, what this actually unlocks is a number of interesting things, right? So, when you have a wrapper, is effectively you're actually just creating another layer of obfuscation between the on-chain asset and the real-world asset. But when you're directly tokenizing title like we're doing, what it means is that if there's some sort of issue with that asset, whether it's in a DeFi primitive, a lending protocol, or something like that, there's an actual enforcement capability in the real world, right? It's actually recognized by the government in the tokenized form. That's one of the biggest issues that we're seeing is like, in order to have this, two tracks going into one, you need to have the real world, recognizing. Sorry, I'm really jet lagged right now. I've slept for like 4 hours. I live in Hong Kong. Basic recognition of the token being the real world asset, right? And until you have intermediaries like a government agency or a regulator that says, hey, this is the real thing, that becomes a problem. So when you tokenize something, hold it in an SPV or a wrapper, you're not actually owning the real thing. The SPV owns the underlying asset, right? So this is really exciting stuff that we're working on in the UAE. I think it's probably the only major market that we're seeing this happen in. And obviously, when you have a one voice system, it helps that you can have a central government or sovereign nation that says, hey, this is the right way to do it, and things move a lot quicker in environments like that.
That kind of reminds me of the whole NFT craze where people are like, you're not actually owning anything in some of these, you're just owning like a link to something. Yeah, you're owning a JPEG that's in a link somewhere, whereas obviously some of them are actually on chain. But going to Robert, I want to hear more about like one huge thing I hear that I personally have questions about is like regulation. Like I feel like that's the biggest holdup in this space. Yes. It's one, like there's a reason we have ADRs and all these regulations about whether a stock can trade in one place or another place. And I feel like people are like, yeah, we're going to be able to trade it 24/7 around the world. And I'm like, there's a reason you can't do that with stocks and bonds and different things. So Robert, I'm curious like what your expectations are for the regulatory environment for all this stuff.
Yeah, I mean, at a really high level, regulation is a layer on top of legislation. And I think in the US, we're seeing two things that have changed very quickly. One is the regulatory interpretation of what should happen given the legislation at hand has shifted radically as, the Gensler SEC has become the, UYEDA/Atkins SEC. And all the other regulatory bodies as well have shifted dramatically. But that's a layer on top of legislation. I think what's really exciting is this year we're going to see stablecoin legislation, we're going to see market structure legislation, we're going to see an actual codification of the rules in the US around crypto and the way it's supposed to be operating in a way that we haven't had ever. And regulation has existed to interpret a lack of rules basically going back to the 1930s and how that might apply to crypto. But we're about to have, for the first time, legislative interpretation, I mean, with like 98% certainty, that this actually goes through and passes, about how all of this stuff should work. And actually the role of regulation decreases when we have modernized legislation. There's less to interpret, there's less to, suppose. And so, the environment is incredibly optimistic. I think, hopefully we don't bounce, back and forth between two different guardrails of like, hostility to crypto and an extreme support of it over the next couple cycles, and we reach an equilibrium where there's very clear rules and everyone knows how they work and like everyone's happy with it. But we're definitely headed in a great direction right now where it seems like anything is possible.
You wouldn't know by the prices. Jeff, let's go to you. He has like one of the best titles I've ever heard of. So it's head of alpha strategy. It's just give us some alpha. No,
Yeah, give us the alpha, Jeff.
yeah, give us the alpha. No, but like, what do you like on the ETF side of things? Like, one of the huge things is there's a lot of derivatives now. Bitcoin ETFs now have options. I've seen a ton of filings for a whole bunch of different ETFs that are focused on convertible debt, focused on companies that are holding Bitcoin on the balance sheet. Like, do you think those are going to be institutionally adopted? Like, is it the people that don't want to hold Bitcoin might go out a different way in the same way that, like, you know, Saylor always talks about stepping up and stepping down your exposure to Bitcoin, which you have a lot of thoughts on MicroStrategy. But I'm curious, like, what you think the next wave of adoption is. And we're going to get some altcoin ETFs, some index ETFs. Like, what are you most bullish on for institutions and investors in the ETF space?
Yeah, to put it really simply, as I've been able to engage with institutional investors, there's basically two things that they really care about in the context of like crypto and what crypto and Bitcoin in particular represent. One is there a risk managed way to access it? And the second is there a more diversified way to access it that might also include some risk mitigation strategies? And so on the first point, it is true that institutions have different degrees of risk preference, right? Every financial institution has varying comfort level, and that's why we have things like securitization technology, tranching technology, and all of these things to create derivatives and overlays and ways people manage their programs. And so to me, it isn't surprising that someone might say, we like Bitcoin, but we actually need to access it in XYZ kind of way with these kinds of risk parameterization. And Michael Saylor's MicroStrategy story is a particular version of that, right? When he's coming to the market with a variety of instruments in the capital structure, from convertibles to preferred equity that has a conversion right, or preferred equity that actually has a perpetual cash dividend. Like, these are all like a buffet of options for investors to be like, what kind of flavor of Bitcoin do you want today? Like, here's 4 choices. And so, in my opinion, everyone knows instinctively, besides price, which we love, we want Bitcoin to go up, the other thing that people recognize is that volatility is extremely, extremely worthwhile. And that if you monetize the volatility, there's a premium there. And so the advent of Bitcoin ETF options last December was huge, because this is really the moment now where we're going to see like structured products. And I do think institutions are interested in the idea of like, yes, I want Bitcoin exposure, but maybe I want to cut my tail to a max loss of 20% by having a put, and also at the same time, financing that by selling a call that's like 160% or something, where they're like, I don't need to make more than 60% a year. Like, it's possible institutions have these kinds of preferences. And so the things that we're focused on at Bitwise is to think about imagining these structured product categories where we harness volatility and diversity in the wrapper we know, which is ETFs, and actually kind of take it to the next level. Like, what's more interesting than just like a Bitcoin spot ETF? So one of the products we launched last week is actually the first of its kind. It's called the Bitcoin Corporation Standard ETF. And what it does, it's a rule-based methodology where we go out and buy public equities that own 1,000 Bitcoin or more on their balance sheet. So this is a way to get exposure to, of course, crypto companies, but also companies like Block or Tesla, or some global companies like Metaplanet, or a medical device company called Semler, and you actually can build a diversified basket of crypto-adjacent companies with Bitcoin Beta Plus. So I think these are the kinds of things that institutions have some interest to explore that doesn't look so singularly dependent on, you know, the price of Bitcoin day to day, which we all know we love and want it to go up, but sometimes it doesn't.
So most of your fund it's a private fund, right? It's a hedge fund. Real quick, one sentence answer, like, is the stuff you're doing in that fund ever going to be viable in a public fund wrapper, like an ETF or a mutual fund?
Oh boy, I would love it. I mean, this is my dream of tokenization. In the future, folks like Securitize are working towards the idea is that these private funds actually don't need to have like a lack of secondary liquidity, right? Like, going back to the point, like these private credit hedge fund vehicles, these 3C7, 506B type funds, they're basically just investment structures. And it's to maybe accommodate the liquidity of the underlying assets, but it's most often to accommodate the business. And so if you can actually provide a world in which there's secondary market liquidity to these types of private funds, I think it's a game changer. The idea that you can invest in private equity funds, but you don't actually have to wait for 10 years because you know there are buyers who can look through the asset and pay for it and create some transparent secondary market is a liquidity transformation of an existing asset class that's never had it. And I think that is kind of the tokenization story that really does permit the fund, for example, that I manage, that could one day be accessible to a more broad-based audience than qualified professionals.
Amber, you're very familiar with like the European ETF market, which is much more amenable to different tokens and coins. I'm just curious if you could tell us a little bit more about what you're seeing from institutions on that side of the pond.
Yeah, I mean, so in Europe, we've had ETPs since, I think, 2013. First ETP listed in Stockholm, on the Nasdaq Stockholm exchange. So we've been, like we tend to do in Europe sometimes, we are good at, the early innovation, and then we struggle to get AUM and scale, and then the US comes in and does it 10 times better. So the European ETP market is much more kind of fragmented. There's a lot of smaller ETPs. Including some interesting things. I mean, we launched something called the Bold Index, which is a vol-controlled Bitcoin gold rebalanced index that is a European ETP a few years ago. And so I would say that we've been early on in creating all those ways to invest in a ETF, ETP-like product to get exposure to crypto. And then, yeah, it's been a year now that the US ETFs, over a year that the US ETFs have been approved, and clearly it kind of crushed the AUM of European ETPs, but still a very interesting market, and I think it's going to grow.
So Jeff kind of mentioned like the private credit stuff. KKR, Hamilton Lane, Apollo, like all of these people are talking about doing tokenization things. I'm curious mainly from Robert and JP, like to talk about like, are you like worried that they're going to come in and like take out you guys as kind of incumbents in the space? Are you looking to partner with them? Like, how do you view these like behemoths from the TradFi world, including BlackRock, to name, like coming over into the space and competing? So I mean, specifically for you, like that deal you were talking about, I know the Biddle fund from BlackRock got some of that money as well. I'm curious to hear your thoughts, Robert.
Yeah, I mean, there's going to be early movers to adopt a new technology, right? From asset managers, from banks, whatever. And then there's going to be late movers, which will be probably like 4/5 of the industry. I think it's great that there's asset managers who are excited about doing things on chain. I think it's great that there's banks that are excited about doing stuff on chain. It's still the reality that like 98% of those industries is not interested in doing stuff on chain yet. And so I think it's a great sign. I think we're at like the starting line or like chapter 1.5 of what this looks like and what comes on chain and what are the products and who are the major players. And, all of this will evolve, but I don't think anything is competitive. I think it's, shared signs of enjoyment and optimism.
You were very vigorously waiting to say something, JP, so go ahead.
I mean, I think any RWA focused, project, particularly if you have a coin, would love to have a BlackRock or a KKR or Apollo as a partner, right? And we've seen that, right? There's companies that try to associate with those big players.
They coast on the branding.
Yeah, exactly. It's an important thing, right? So for sure, we would want to work with these type of people. And obviously, when you're talking about a lot of these products coming on chain, you need to have something that is easily understood by people. And those big brands are easy to explain. And when we're talking and distributing some of these products to investors, they already are buying this stuff in the real world. They're already buying it from their private bank, particularly in the UAE. Like they're already getting exposure to some of these products. But actually what tokenization offers is a little bit of a smorgasbord or a buffet, where now it's not just the private bank offering, but it's actually this private bank offering, this private bank offering, this private bank offering, and this private bank offering. So you can get everything under the sun, which is something that we've seen people are quite attracted to. So we've done a number of different tokenization products in private credit, in money market funds, that bring those big brand names to the table, and it's something that again, down the line, if they want to do it more directly and natively, it's fine. But in the meantime, happy to have that association just by having good quality product on chain. That's really important, because like tokenization for the sake of tokenization, just if you have a shitty asset, it's still a shitty asset.
Yeah, we like to say the same thing for investment strategies. Just because you're putting if the dog doesn't like the food, just because you're putting it in a gold-plated bowl doesn't mean that it's going to be good food. We only have 2 minutes left, so I'll keep these quick. I just want, basically, all of you are building, right? You're all building in the space, and the question is like, will the institutions come? That's kind of been answered for the Bitcoin ETFs, maybe even a little bit for the Ethereum ETFs. Tokenization, we're seeing it's a start, but I'm just curious, like, one, it's mostly institutions kind of dipping their toes in the water at this point. When do you think? Well, one, are they going to fully jump in? And two, when do you think it's going to happen? I'm curious, like, Jeff, more for your point of view, like, these other altcoin ETFs and stuff, do you think there's going to be interest? And then from the rest, more so tokenization side of things?
So my view, and this is my personal view, this is not Bitwise's view, is institutions for now really are focused on Bitcoin. They're focused on Bitcoin for all the reasons that we understand what it represents. It has like a singular narrative as a store of value that's not very difficult to understand. Once you leave Bitcoin, the story on technology, the utilities kind of befuddle various motivations that make the conversation challenging. The thing that I feel, again, going back to the evolution of Bitcoin's financialization, is that historically people really liked trading these altcoins like Ripple or Solana or Doge or whatever else because they gave you some levered beta exposure to Bitcoin, and people thought it's a levered way to play the crypto price game. The reality is, I actually think most institutions now will realize the power of Bitcoin options and get the same kind of thrill with less basis risk, in that you don't need to like play the lead lag relationship of Bitcoin versus Solana and play like that game. You can literally just buy, you know, a long dated out of the money call Leap that has 10 delta and actually like play that. And so I think institutions are more interested today in like the opportunity and the financialization of Bitcoin and crypto volatility in general. Now, altcoins are tremendously volatile. So as they have staying power, I'm certain institutions will also have a way to financialize those altcoins too.
Keep it quick because we're a little bit over time, but JP, I'm curious, when do you think tokenization, when are we going to get off the dual track? When is it going to be actually?
I mean, I said like it's a multi-cycle thing. So actually, the next like proper bear is when a lot of the real foundation elements of secondary market liquidity is going to start getting built up. So I think maybe 5 years. 5 years.
I think the inflection point is starting.
Robert?
Yeah, I mean, I agree it's starting. Institutions are just like any self-motivated capitalist actor in that they just want more money. And so, the reality is that everyone's interested in crypto because there's the opportunity in some corner of it in some way to make more money.
Great. All right, that's all we have time for. Thank you, everyone.
All right, thanks again from those panelists. I love the honesty of Robert there, just saying the best incentive is just making money. That is a true fact. Okay, so for our second last panel for the day, we're going to be hearing about the allocators' perspective on crypto. So give a warm welcome. We're going to have Omar Naeem up on the stage, as well as Manoj Vasudevan. Welcome aboard.
No, I think you should sit on the other end. Do you guys have a preference? Is this okay? Is this too weird if we're on opposite ends of the stage? Okay, I'll sit closer. Hi, everyone. I was questioning, hi, Lori, if the room would thin out, and it really did.
Yes.
But you're not really going to miss anything, everyone leaving. So if you can, actually, you can stream it. So I'd like to introduce I should say myself first, I think. So my name is Omar Naeem. I'm the founder of LW3. LW3 Digital is part of LW3, and our mission there is very simple. We want to maximize the adoption of digital assets by the institutional allocator community. So basically, exactly what the last question was on the previous panel. Like, how do you actually accomplish that, right? It's not, our opinion is that it's not by going on CNBC, it's not by launching meme coins, and it's certainly not by running for president. I guess I'm referring more to something that happened a few years ago. It's through education and creating a safe space for the allocator community to actually learn about the space, not be sold on the merits of it. God knows they're sold on everything else. Next to me is someone who is, I call him the Indiana Jones of the industry. One of the big challenges for allocators getting anything passed with their own advisory committees is that they're so far removed, and it's a really, one of these terms I use is, there's a Japanese word that's called kuchisabishi, which means lonely mouth. When you eat because your mouth is lonely, so to speak, right? And I say, do you know what, how do you say in Japanese, I spend 99% of my time on 1% of my portfolio? It's called investing in crypto, right? And so very few people actually have done it so far, and the guy next to me has done it in a way that I haven't seen anybody else do it. But we can get into that in a second. Manoj, maybe go through your background a little bit.
Hey guys, Manoj Vasudevan. I'm with Kaust Investment Management Company. So for those of you who don't know, Kaust is King Abdullah University of Science and Technology. So we're the endowment fund or the investment arm of Kaust University. This is a university based in Saudi Arabia. Think of it as the legacy of the late King Abdullah. And fun fact, it's one of the 3 largest endowment funds in the world, university endowment funds. The university probably has one of the largest university campuses on earth, about 8,000 acres of contiguous land. And we've been around for 15 years now. The team that runs the endowment is based in Washington, DC, product of the early team being from the World Bank, and run like a typical university endowment, have a strategic asset allocation across publics, privates, hedge funds, real assets, and crypto is sort of a new technology segment for us. I shouldn't say it's new because we've been at it. Our journey into blockchain actually goes back to 2018. It was the year when we experimented in terms of having a small allocation in blockchain to learn about it. It wasn't as if we had a thesis around it. It was also the year when the first institutional crypto funds were launched. So it was a way for us to learn. And it actually sort of fast forwarding to 2021, it was that year when we actually came up with a robust thesis around the space, which we've been implementing quite actively over the past 18 months, post-FTX. So today, we're close to 1% of the endowment in terms of crypto exposure. And given how large the endowment is, it's pretty meaningful.
Has anybody here watched Doctor Who, remember? So we're going to get into a bit of a time machine right now and go back to before Manoj and Kaust had any exposure to the asset class. So I won't provide any sound effects right now. So Manoj, most allocators dismiss and still often crypto outright. Yet you took the time to deeply understand the space. Was there a personal aha moment that you saw the blockchain potential and to put time into it?
So I think there were 2 aha moments personally. I think for the firm, the aha moment happened more recently, I would say, post-FTX. But for me, this goes back to 2020. We'd already invested a little bit, sort of learned about the industry. And then come 2020, what really sort of stood out were the network effects around Bitcoin. And I think this is an underappreciated aspect of Bitcoin. As in, people understand Bitcoin for the most part. Most institutions understanding it's all about the scarcity. It's about the 21 million cap. It's about being store of value. But even if they had understood that, most people don't value store of values as institutions, right? Most institutions, and when I say institutions, I'm not talking about the family offices. I'm talking about my peers who happen to be endowments, foundations, pension funds. Most of them don't have a gold allocation. So why would they care about Bitcoin, right? But the network effects that I was seeing, especially in the year 2020, was around, these hedge funds that we had admired, for years, Paul Tudor Jones, and on the corporation side, Michael Saylor, One River Asset Management in terms of the Bitcoin trade that had pulled off in November 2020, and they had a shareholder. One of their biggest shareholders was Alan Howard of Brevin Howard. So we started to notice all of this in 2020, and Bitcoin is something you can't really value in terms of intrinsic value. And it's all about imputed value, which really takes you to network effects. And truly understanding network effects was what got us over the hump in terms of valuing that asset. So that was Bitcoin, right? So you got to sort of keep that aside. What really got me, what sort of gave me the aha moment on blockchain in general was something that Naval said, Naval Ravikant said in one of his podcasts about blockchain being a network of scarce resources, and it giving a system of orchestration between the demand side and the supply side through a token system, through a crypto asset. And that sort of really stood out to me because you really can't like pull off orchestration of demand and supply side through a traditional equity system because value does not stream seamlessly, value does not transfer seamlessly, and you could now do that through a token or a crypto asset. And when I had applied that concept to Helium, which is what my phone runs on today.
Your phone runs on Helium?
Yeah.
How many people in the audience have Helium on their phone?
There you go.
Like one person.
Like for those of you who don't have Helium, I highly recommend you guys get on a Helium plan. It's about $30 per month, all in, unlimited data, unlimited talk time. There's even a freemium plan, so you could get a telecom connection for $0 per month.
Like he's pitching right now. This is
so
amazing.
It's a live use case. Like for anybody who questions, like what are the use cases of crypto? This is it, Helium.
I've used helium balloons, but that's a little different.
And by the way, it's a Harvard case study right now. So it's and I highly recommend people go and like read about it. So, but that was a haha moment, right? And I had seen that, and I sort of like saw all of that happening in 2020.
So you were what he didn't mention in terms of the growth of the endowment and their digital asset exposure is that, which I found to be the most eye-opening, was that you were essentially running like a multi-year internal education like campaign, like quarterly or so emails to his entire IC about what was happening in crypto, including Post-FTX email, which I still remember that you wrote. What kept you motivated to do that when it wasn't your job, at least not directly, because you covered real estate at Kaus as well, and when there was no immediate sort of upside, I guess, in some ways, maybe some downside?
So I think when I sort of had these aha moments personally, the first thing I did was, I think towards the end of 2020, I made my first presentation to the internal team. And it didn't fly. I had like 30 minutes with them. None of it really like sort of hit the spot. And I was discussing with some of my peers who were also in the same spot as me as to like, how they were also facing challenges in terms of like getting the message across on how to really appreciate this asset class. And I think in 2021, there was this idea that like, maybe, no matter how many presentations I make internally, it's just not going to fly, and maybe I should try the writing method. So I wrote a bunch of internal memos, and they were more like long essays on what I was learning. So it was real time, sort of translating my learning through podcasts, through reading, into a long memo of sorts and sending it to the entire team. And this would be about how we as allocators should think about Bitcoin as an asset, blockchain as an asset class, what's the market structure at this point in time in terms of like how a life cycle of a blockchain company actually sort of plays out. And these were new concepts because we were dealing with an extremely unique financial instrument called a token, which people were not used to, right? So most people really didn't know where to bucket this in their systematic asset allocation. So it was a bunch of education and memo writing that sort of like did the job over a period of time. It was constantly sending out memos, and most of the time, nobody read those memos. You could actually see that in the, like, if you've used Outlook and sent out a mass email to your team, you can actually see how many people open that email and what's the average reading time. And the average
I have a team of 4, it's still at 0.
And the average reading time was actually 30 seconds.
Wow.
In these long essays, but I had like 3 or 4 actual readers within the team.
Wow.
One of whom was my CIO, and sort of like that sort of like kept me going. So.
Well, so people were dismissive, confused, intrigued. Did anyone ever pull you aside and saying, "Hey, listen"?
No, people were not dismissive, and typically you don't find people writing internal memos like this on technologies, especially in a setting like an endowment or a foundation or a pension fund. So obviously they were intrigued why I was doing that, but it was my way to sort of slowly induce education without any expectations.
So
because I was sort of like, I was doing it selfishly myself because I was trying to refine my own thoughts and trying to like build my own thesis. As I was writing those essays. But most, I would never, nobody was like, it wasn't as if people were dismissive. One, because, most of them weren't reading it. And I think people were like, amongst the words that you used, it was mostly intrigue.
Yeah.
Amongst the team.
So, like, I guess if you hadn't taken the time, written those emails, so to speak, do you think that they ever gotten to the point where they would have invested?
Definitely not. Impossible.
Yeah.
It's just, I was like a dog with a bone, constantly nipping and constantly talking about blockchain to a point, right? Everybody got tired because there were these constant memos. I was constantly talking about it. In fact, I'd sort of like, question in 2020, like, why are all these hedge funds buying Bitcoin, right? And obviously, ask most allocators at that point in time, they would say, oh, they're talking their book, right? That's why they're talking about buying Bitcoin. But it was more about the network effects at that point in time, and that's what gives Bitcoin its reflexivity, its convexity, and so I feel like if you're not constantly educating your internal team, especially for in environments like an endowment or a foundation whose main job is not to like explore technologies, it's to actually underwrite managers across these 4 asset classes. You're never going to go deeper into blockchain as an asset class. So.
Yeah, it's really interesting it's almost like a structural sort of challenge for the institutional allocator community, is that very few of them have the resources to dedicate to, this asset class, certainly in the way that Manoj's done it.
But I have to say that, it's not as if people didn't allocate. There was this 2021 bull run. Every Tom, Dick, and Harry sort of allocated to venture funds in blockchain. But I think most of them are pencils down today. Like post-FTX, most of them are pencils down. And I think if you sort of don't have a strong foundation within your team and then allocate to blockchain because it was hot, and it was hot in 2021, it's bound to happen that when there is a significant correction or an event like FTX, everybody goes pencils down. And that's pretty much what happened. And is what happened. It's still happening now.
So how do you feel in terms of your internal sort of situation? Do you feel validated? Do you walk around with a cape on, or do you feel it's still very early in innings in terms of whether or not this was in terms of also Cal's exposure to the asset class?
I wouldn't say
validated.
Validated.
Absolutely.
We are far from sort of like achieving the goals of the industry and what the industry is setting out to do. Maybe that validation will happen when we all have our first iPhone moment. It's still not happened. People say stable coins are sort of an iPhone moment, but a crypto product that really takes off and has 100 million users, right, overnight, like ChatGPT, that hasn't happened. I think that's when I think the industry will truly be validated. But I don't think, even though, we have significantly grown our allocation and the team now believes that this is something real, I don't take it for granted because a lot of allocators came onto the scene in 2021, right? And they're no longer there because of what happened with FTX, right? So there's constant education. I am very cognizant of the fact that we might have something break later this year or in 2026, something like a Luna or something like an FTX, which sort of again, takes our industry back to a GFC type of a moment, and then everybody goes pencils down again. And my job is to constantly educate and keep the team abreast across all these developments, and so that if something like that happens, we know why, and we sort of truly embrace that bust and sort of continue allocating. It's very easy to sort of take a step back, especially when things go wrong.
So we have a few minutes. What's a crypto analogy that you wish that more people in traditional finance would understand? Sorry.
I think traditional finance, as a rule, doesn't like volatility, right? If you think about the classical endowment model, if you were to just simply invest in the markets, you have sort of this S&P curve that's volatile over a period of time. And the whole point about the endowment model or like an institutional model is to sort of mute that volatility and still achieve equal or if not better returns than the S&P, right? So it's all about like having a smooth curve. And the thing about crypto is that it is one technology that is also a market, right? You don't have a technology that is also a market. And with any technology, you can't build anything substantial or important without, like I would say, exuberance, irrational exuberance. Like you need this type of retail mania, this type of speculative mania, like investors like us to open up our pocketbooks, to really invest in the traditional rails, to invest in the backbone and the infrastructure that the industry needs. And the analogy that I will make here is, think about what happened in the late 90s during the dot-com bust. Like overnight, $5 trillion of value vanished. A lot of people lost money. I think the drawdown in the NASDAQ was 78 to 80%. But even though a lot of the capital was lost, a lot of that capital that was invested in the 90s went to building the backbone of the internet that we know of today. It went to building Google. It went to building Amazon. And I think as an industry, as TradFi looks into blockchain, it's about really embracing those booms and busts, because no technology will ever be built and will ever succeed without booms and busts. And which is what TradFi gets scared about, right? Like, everybody sort of like went pencils down after FTX, but FTX was just a normal, sort of like a blip in the traditional progression of a futuristic technology, right? And so as you sort of like think about these booms and busts, and they're pretty violent, especially in blockchain and crypto, you have to consider the fact that it's always about whether the technology is going 2 steps forward and 1 step backward. And that's always been the case with blockchain. And if you see that, just, it's about embracing that technology then.
1 step forward, 2 steps back?
No, 2 steps forward, 1 step backward.
Okay. So. That's like a country dance, I think, country music dance. Anyway, thanks, guys. Everyone give them some applause.
All right, thank you, Omar and Manoj. So for the last panel of the day, I am going to be here, and I'm also going to ask for Mike Ippolito and Quinn Thompson to join me upstage here, and we're going to be doing a live roundup edition of Forward Guidance, live from DAS. It's going to be a lot of fun. Let's do this. Okay, so I want to ask before we get into it, raise your hand if you've listened to the Forward Guidance podcast ever. Just curious who's in here. Nice. Okay, so we got some listeners. Wicked. Well, we'll spare ourselves too much of an introduction in that case, but we do have the live stream, so we will introduce ourselves anyway. But my name's Felix. I'm the host of the Forward Guidance podcast. I interview macro thought leaders every week, and then I also host the Roundup alongside Quinn Thompson. Feel free to introduce yourself.
Hey guys, good to be here. Quinn Thompson, founder and CIO of Lecker Capital. We are a global discretionary macro hedge fund with an outsized focus on crypto and digital assets.
Hey everyone, my name is Mike Ippolito. I'm one of the co-founders of Blockworks and an avid listener of the Forward Guidance podcast. And whenever they have me on, I'll yap with you guys too.
Yeah, occasional participant and a leader of the Guys Emporium in that respect, at least culturally and philosophically.
We need Tyler here for the full Guys Emporium, reunion. RIP.
I know, we miss that guy a lot, but he's off doing some big things right now. Okay, so we are recording this a couple hours after the FOMC meeting, and there's a lot to unpack there. So we're going to start the conversation by just level setting on what's going on. So going into it, obviously the expectation was for them to not really do anything. They're going to pause. There's no expectations of a rate cut, no expectations of a rate hike. That wasn't the news. What was the news is trying to get an understanding is how is the Fed and Jerome Powell thinking about what's going on the fiscal side of things, obviously tariffs and those different policies. So with that, we got the SEP data today, the dot plot, and that provided an interesting line of sight into gauging how are they thinking about inflation risks, how are they thinking about growth risks, and how does that all come together into what is their perspective for implementing monetary policy. So I'm going to keep it simple here and just go through a couple data points to understand how are they thinking about it. So for the growth forecast for 2025, they're expecting it to come down from 2.1 to 1.7. From there, they see that level setting out and seeing it as so much like a short-term growth risk. Now, what's interesting is it's the complete opposite in terms of inflation risks. From there, they're looking at core PCE for 2025 to go from 2.5 to 2.8, and then eventually trickling back down to 2. Overall, in terms of the rate cuts that they expect, it's actually quite similar to the December meeting, which is the last time we had the SEP data, and that's 2 cuts, which is pretty close to where the market's at. So there's a lot of different mixed points in there, and then we also got some updates on the balance sheet and liquidity and what's going on there. So we got quantitative tightening updates. Heading into it, we saw from the FOMC meeting minutes that there was going to be some talk of pausing it, having to do with the debt ceiling dynamics. So we'll get into that. But interestingly enough, they only tapered the treasury component of QT. So they brought that down from 25 to 5 billion a month. So still doing a little bit, but pretty negligible. But then they're holding MBS constant. So the mortgage-backed securities, and I think this is key and we can get into this, but they want to get those MBS off their book, and they are not interested in slowing that down by any means. So there's a lot to unpack there. Quinn, you've been pretty quick to the trigger here in calling it hawkish despite markets rallying. So I want to pass it to you to get an understanding of what did you see there and how are you thinking about it in terms of the FOMC?
Yeah, so I like to look at the meeting over meeting change in obviously the statement and rhetoric and press conference, but also the dot plots, which only come out quarterly. And when you compare the two, obviously we had growth expectations down with GDP lower, unemployment rate higher, and inflation expectations higher, which is very stagflationary, with the median or mean interest rate projection cuts the same. However, under the surface, you had the distribution move to a much more hawkish stance. You had the number of participants expecting 1 or fewer cuts go from 4 to 8, and expecting 3 or more go from 5 to 2. So it was a very meaningful shift in kind of the mean of the group. And I think I understand the dovish interpretation as, well, they marked up inflation expectations, but they didn't introduce potential for hikes or something worse for risk assets. However, it's not good news. There's nothing here for me to really celebrate particularly in a backdrop of the first time since COVID, even probably, that fiscal is a negative impulse on asset markets, with Doge efforts and immigration being effectively halted from a % plus growth of population every year since Biden became president to 0 overnight from the southern border. So I just think that the overarching backdrop for the economy, growth, and what I expect to eventually show up in corporate earnings for the first time since we've had all these market pullbacks is kind of deterioration with no positive impulse on the liquidity side. Yes, okay, they're not hiking. The QT reduction is positive, but it doesn't, give an impetus. So we can chop around here, but it doesn't make me excited.
Yeah, I think that it wasn't particularly good or particularly bad. There was another interview that went live today with Treasury Secretary Scott Bessent, where he outlined in quite a bit of detail how Treasury and honestly this administration is thinking about growth, inflation, et cetera, over the course of the next couple of years. And I think if you just look at this, I think this administration and politics is in the driver's seat at the moment, much more so than inflation or the Fed. And so if you look at this administration, they are very, very focused on balancing the budget. We know that debt is something that they care about for the first time in a long time. And during this interview, Scott Bessent sort of went through how they think about alleviating the situation. And there are a couple of things that you can do. You can do austerity. You can try to grow your way out of the situation. You can do financial oppression. Politically, financial oppression is not going to work, I think, with this president in particular. He's very sensitive to the common man. And so I don't think that's a great option. Scott Bessent was very against austerity or severe austerity because that negatively impacts your ability to grow your way out of it. And so growth seems like the priority. And so when you look at kind of the three big components that they've thrown out so far. There's tariffs, which is negative growth, but then there are tax cuts, and there's also deregulation. And so what he outlined in his speech was they started with tariffs first, which is obviously not good for growth, and you've seen markets throw a little bit of a hissy fit for the course of the last month. But what they have in their back pockets and what they're counting on is deregulation to drive growth and tax cuts to drive growth. And obviously spending is going to be a lever that they can pull, how much they really end up cutting on the Doge side of things. And so I think markets are pricing in tariffs because that's what's happened so far. But ultimately, you do have the promise, right, of tax cuts and deregulation later this year, but it's kind of a known unknown. We don't know what that's actually going to do in terms of generating growth in the real economy. So I think that's it's very choppy in the midterm, but I think later on towards the end of this year, you have things to look forward to.
Yeah, I think that's the good point to bring up is the direction and sort of who's moving the pieces on monetary and fiscal policy. I firmly believe it really starts with the Treasury, and people probably don't account for how closely intertwined Fed and Treasury policy actually is. It's been very obvious the last number of years, and I don't think it's changed in the new administration. In fact, I think Powell, much probably against what consensus view is of this tension between the Trump White House and Powell, is actually much more aligned interests this go around, at least now. You know, if we go through a big deep cut of Doge and growth gets hit and we tip into a recession later in the year and they have to start stimulating pre-midterms 2026 and inflation's not down yet, there might be tensions. But in this point in time, I view very aligned interests and incentives between the two camps, and I can kind of feel that from Powell, where they're very comfortable waiting, and I think they're being assured of that from Besson and team. So that's a bit different dynamic than prior, you know, at least last year, where it's like, hey, we got an election to win, you got to juice these markets.
Yeah, I think that's such a good way of framing things, because I think a lot of people are getting it wrong right now in that interplay between Scott Bessent and Chair Jay Powell. I've seen a lot of takes where they say, oh, look, you know, Bessent and Trump are trying to tank the economy to force the Fed to cut rates. And I don't think that's the way to think about it. I think you're correct in the way to think about it, which is, okay, let's think about what Powell has been thinking about and dealing with for the past 4 years now, since COVID, basically, which is a couple things. You know, he's trying to get a handle on inflation, and with the tools that the Fed has, they're limited for a number of reasons. We've talked about them before. But overall, he's been going, you know, you always have to think about the economy through the lens of fiscal and monetary and the interplay between those two. And on the fiscal side of things, we've been running some of the loosest fiscal regimes. You know, we've been running a recessionary playbook doing an expansion, right? So, you know, we have huge deficits. We have stock prices at all-time highs all the time. That's leading to this further consumption of, you know, higher income classes of society. So, you know, I think those are the two big reasons why we haven't seen inflation return to 2%. And now you have this administration come up and go to Powell and say, hey, look, you know, we're trying to get the 10-year yield down. We're trying to get a handle on things. We're trying to pull back, you know, fiscal retrenchment. I think Powell's over the moon.
Yeah, I mean, the most clear trade to me here is longing bonds, because, you know, you have the Fed attempting to respect the value of the dollar by not, you know, adding liquidity in the regime and being very patient on potential future cuts. And my view is that they're in a fairly hawkish stance. And then you have the same thing on Bessent. Bessent knows there's a big Treasury supply issuance problem on the horizon if they don't fix the deficit. And, you know, how do you fix, you know, if you're the largest bond salesman in the world and you want to tell a good story about why your bonds should be at lower yields, either can get growth down, get inflation down, or both. And, you know, there's another pillar to this, which is energy. You've noticed how they have been dead set on solving Russia and Ukraine. Very, very obvious strategy to lower oil prices. The deal with the Saudis that I don't think got enough attention, but, you know, that was monumental in terms of trying to, you know, add more supply. But on the other hand, they do have things like bringing Iran from 1.5 million barrels to zero maximum pressure, the potential that the Russian conflict doesn't end so soon. So it's a tight needle to thread, but the main point for me is that the Trump admin is willing to go through pain. We have not seen an administration in a long time willing to do that, and they seem very willing. So I'll take them at their word as long as their actions corroborate, which they have.
Yeah, Mike, I want to ask you because you are a student of history. That's one of those traits that I feel
It's a nice way of calling me a nerd, but thank you.
yeah. But okay, look, so they're playing with fire here. If you're trying to do what they're trying to do, which is to get growth slowed and pull things back and actually pull it off without diving into recession, because I'm still not in that camp. But when you look at history of these moments where you go through these cycles of decrease in liquidity, decrease in growth, and then swooping underneath and trying to catch it, basically a soft landing, but from a fiscal side, and not letting it go to a hard landing. When you look at previous crises during history, like, what's your perspective on how likely this is for them to pull off without it going too far? And then, oh shit, now we have to, run up even greater fiscal deficits because we went too far too low. And now we got to revitalize the economy because, we messed up and we're in a recession.
I think that the perspective from this administration that I agree with is that you need to grow your way out of this, actually. I think that there's a sort of an incorrect view that you can cut it. The actual verbatim phrase from Secretary Scott Bessent was, we don't have a revenue problem, we have a spending problem. And so I think his perspective, you often hear that you can't look at a government like household financing or a startup, and I think in a lot of ways you can't, but I think in this one way you can. There are definite revenues and there are definite costs. And if you were looking at a company or a startup here, there's not a massive problem. We've gotten out ahead of our skis, but we still have the most robust economy on Earth. It's growing in a very organic and steady way. And so I think you can largely look at Doge as a way of just reining our costs in or running at a more break-even rate. And I think a pretty decent framework for looking at the economy right now is over the course of the last 2 years, we had a spending problem. And most of the job growth is being driven by government. And I think there's an attempt to shift growth onto the private sector through deregulation and tax cuts. And I think it's a good plan. Like, I don't really see a path here where everyone tightens their belts and we take huge cuts, and I just don't see it without a massive crisis. So I think this administration's perspective is we're going to move the impetus of growth from the public sector and government and giving away a bunch of jobs like that into the private sector, and we're going to try to incentivize job growth. And I think alongside that, they're very sensitive about, honestly, terming out our debt. So there have been some, I think, there's a lot of question marks around Janet Yellen's shift in terms of how she ran bond auctions for a little while, moving much more toward shorter dated bills as opposed to longer dated treasuries. And I think that they're going to change that moving forward. They can mess with things like the SLR for banks. And actually, Bessent's quote was he thinks that they can reduce BIPs 70 basis points alone with just that lever.
Yeah, something that's I want to pull into this discussion here, and I'll ask you, Quinn, in a second here. But okay, so their goal is to get the 10-year down. They've achieved, I think, 50 bips so far at the cost of a 12% equity correction. That's a pretty large trade-off, I would say. And then in the same vein, I don't think they anticipated such a fiscal reaction, especially from Europe. I wonder, and I'm curious on your guys' takes, but did they expect for Germany to unleash potentially $500 billion in defense investment, and for them to actually start running deficits again and taking off the debt leash? Because that leads to higher bond yields, that leads to a higher euro, that leads to a weaker dollar. That all leads to marginally also, just from the correlation of if capital goes back to Europe and chases those higher yields, they're going to be selling Mag 7, they're going to be selling U.S. bonds. That leads to higher bond yields. Do you think they expected that? Because that, to me, is a headwind against their goal of getting the 10-year lower. If we got we got China fiscal coming online too. Those are negative headwinds for bond yields. Do you think Bessent anticipated that?
I love Bessent. I want to be Bessent when I grow up. But he definitely knows this. But the trade after the trade here that I don't think most are speaking about is how you pointed out big of a headwind that is for his objectives to bring inflation down and bring yields down. Because it's all, thus far, it's been 2 months, and for all the progress, or some people view lack of progress that's been made, things have gone quite smoothly, right? We've cut the deal with the Saudis to pump more oil. Russia and Ukraine have largely fallen in line. All our other trading partners have largely fallen in line on tariffs. There hasn't been a big breakout of global conflict or trade war noise. But mechanically, there are things you can't control, and that is the flows, which in this case, lower growth, lower US bond yields, weakens the dollar, and by definition, strengthens rest of world currencies. It makes, there's a reason we've had extreme concentration in our large cap indices in the Mag 7 because it's been the safety trade when the rest of the world wasn't growing, when China was in recession, when Europe's in recession, and the US is propped up on fiscal largesse. But that's reversing. And so we've seen the first shot across the bow here, but there's two effects. One you mentioned is the relative attractiveness of non-US assets. So the US has 4% of the world's population, but 60% of the global equity market cap. There's some mean reversion to be had, making higher global bond yields, putting pressure on the US bond yields. But the other thing is the downward pressure on the dollar also is importing of inflation, where in the last 3-ish plus years, we've been actually importing deflation relatively, or disinflation relative to the rest of the world, because we've had a strong dollar. And so what that does is puts a sort of a floor bid under commodities structurally. That doesn't mean commodities have to go up. They're doing other supply things. They're hurting demand. So they're trying other methods, but there's structural headwinds that come in that make it more difficult. You could even see a situation where China, Europe, Japan start running so hot relative to what Besant needs to do to get our yields down, that the global cost of capital is rising. Inflation starts rising for no reason of his, where you could even see a situation where for him to achieve his goals, he'd have to say, hey guys, you got to tighten up the belt like we are. This is inflationary. I don't know if that's going to happen yet, but so it's a very tight loop to thread, and I have to, at this moment, be in the skeptic camp if it can actually fully get done without more pain first for risk assets.
I don't know. I think, I think that you can look at some of the actions of this administration. This administration does tell you exactly how they think and what they want, right? Trump has been super consistent on this. You can find yields or interviews going back to the 80s, where he thinks that the rest of the world, especially Europe, does not pay their fair share for defense. And he said repeatedly, this is what I want. And then he sent J.D. Vance to Munich, and he makes a fiery 15-minute speech. And, 2 weeks later, they're spending, they're proposing a $500 billion fiscal investment into rearmament, right? I don't know. I'm unclear if that's a good thing for the rest of the world or for all time, but I think that's kind of the trend, and they've made it very clear that that's what they want.
Yeah, so another piece of the puzzle here, which is, related to the reason that we're actually here today, which is a digital asset summit, but there's a lot of cross currents between, what can the administration do with stablecoins as a marginal buyer of debt? What can the administration do with a Bitcoin strategic reserve, and how does that sit within the interplay of everything we're talking about? So I want to maybe start with you, Mike. I'm not actually sure where you stand right now on the Bitcoin strategic reserve and all of that, and how you think about that from the super high level macro goals here of this administration and achieving the goals that they're talking about. Where does that sit within it, and then also stablecoins in terms of being the fastest growing marginal buyer of that debt?
On the strategic Bitcoin reserve, I'm not sure if I get it. I don't really like it, actually. I think that the U.S. still is in this position of enormous privilege of being the issuer of the global reserve currency. The only thing better than having to back your currency with high-quality collateral is not having to back it and being the collateral itself, right? And so I just sort of wonder, if you have a strategic Bitcoin reserve, you're saying this is strategic to my country for some reason. Bitcoin doesn't exist in the real world, right? We don't have liabilities denominated in Bitcoin like we do with petroleum. And so what is the message that you're sending? The only thing that you could be backstopping is your currency. To be honest, I don't love it. That's part of the reason I've never really loved it on corporate balance sheets either, which I know people love in this space. But yes, I'm not a huge fan of the strategic Bitcoin reserve, or honestly the stockpile in general. But that's just my personal perspective. On the stablecoin front, I think that's massive for the United States, and I think it's not an accident that the only, when you hear about, high, like cabinet members or Scott Bessent talking about anything related to crypto, he's talking about stablecoins. And actually, Brian Moynihan, the CEO of Bank of America, when he was talking about Bank of America potentially launching a stablecoin, I thought he phrased it very interestingly. He's like, I don't see the difference between this and bank deposits. And I think if you squint at it, it's kind of hard to see what the difference is between that and bank deposits. But there's certainly a large buyer and already a very large owner of, U.S. Treasuries. And so I think Scott Bessent is a guy who knows monetary plumbing very deeply. Like I mentioned before, he's already talking about messing with the SLR of banks to allow them to be more deregulated and buy more U.S. bonds. I think he sees this as an incremental buyer of bonds. So I think it's part of the reason why, it's one of these massive tailwinds, I think, that exists for stablecoins in the U.S. in general.
Yeah, on the strategic reserve, the best idea I've heard is if the U.S. has some stranded power assets that they could use to mine Bitcoin with excess energy. It's a not great business though. Hash price and revenue profitability for miners is back to extreme lows, sort of bear market lows, just given the growth in hash rate and difficulty. But when you zoom out and just take off the tinted goggles of being a crypto fanatic, you see the 4 countries that have Bitcoin reserves is North Korea, El Salvador, Bhutan, and the U.S. And I don't know, is that super exciting? If you're another country, it doesn't feel like there's this global race to acquire Bitcoin to me. And we're a debtor nation. We're running massive deficits. It's fungible, right? Bessent's we're talking about how intelligent and logical and rational he is, and he's not going to just say oh well, we could sell gold to buy. No, it's all fungible. Debt, deficit. If we spend somewhere here, we have to cut here. If we add here, and he gets that. So I think it's a fulfilled campaign promise thus far, and I don't really see a lot of legs to it. But on the stablecoin front, 2 goals, right? Get yields down, so increase demand for your debt. He's the largest bond salesman, U.S. Treasury bond salesman, and they, like I just mentioned, a weaker dollar is a headwind because it's inflationary, and so he wants a higher demand for U.S. dollars. So both of those things, when you see stablecoins go from non-existent to a top 20 holder of your national debt, is pretty inspiring, and something I would be doing everything possible to increase around the globe. So stablecoins continue to be the most obvious, thing for them to focus on within digital assets.
I want to ask you, I want to get your opinion on the this sovereign wealth fund, U.S. sovereign wealth fund as well. I'm torn between being excited about it, thinking it's interesting, and not 100% understanding it. My understanding of sovereign wealth funds is, if you're a country and you're generating surplus revenue that you can't reinvest back into your own domestic economy, then you move it mostly into the United States. But we're a debtor nation, so that makes less sense for us. But if you had done that, if you had put one of these together 50 years ago, you'd have done extremely well. And Social Security might not be underfunded. But on the stablecoin front, I also wonder if they are looking at this as potential disruption to the commercial banking system. Have folks in this room, has anyone heard the term narrow banking before? My man. So narrow banking was something that has been tried, a couple times over the course of the past decade, but there have been pushes to allow different institutions or even individuals to bank directly with the Federal Reserve. So the advantage of this would be there's zero risk. You have no counterparty risk. The disadvantage of this would be, and why the Fed has always pushed back against it, is one, they don't want a direct banking relationship with everyone. But what they also don't want to do is undermine their own commercial banking system, because who would bank with JP Morgan if you could bank directly with the Fed and take absolutely no risk, right? So it's undermining to them. And so you kind of have, on the one hand over here, banking directly with the Fed. On the other hand over here, you're banking with a commercial bank, which is backed up by a pretty diverse set of loans, right? Like different duration, treasuries, private credit, whatever it is. And then there's this kind of middle ground here, which is stable coins, which are global bank deposits, which are just backed by very short-dated government debt. And it's sort of a low overhead, global from day one sort of bank deposit, actually, that looks maybe like a new form of banking and could actually be pretty disruptive to commercial banking in the US. Not in 1 or 2 years, but maybe in 5 or 10. So I wonder if they're thinking like that also.
On the sovereign wealth fund, I think I'm probably only supportive if Tim Walz is CIO and Nancy Pelosi's running the options book.
Number one trader.
I got some spicy takes on the sovereign wealth fund too. To your point, the U.S. is a debtor nation. I almost said my country, but I'm Canadian.
51.
51. maybe for now.
Freudian slip. Freudian slip.
Yeah, I know. Yeah.
Fentenzar.
Look, if you're a debtor nation and you want to run a sovereign wealth fund, setting aside all the fancy tricks that they're talking about, like, you know, taking the gold reserves and marking it to market and put in there, or, you know, the digital assets that they've already seized, putting that in, that's all great. But if you get to the point where you're like, okay, we want to actually structurally run a sovereign wealth fund, but we're a debtor country, you have to start asking, where does that capital come from? And it comes from the private sector. It comes from taxpayers. So if it's coming from taxpayers, if you're in agreement with that, you're making the admission that you are willing to allow the government to work as a pension fund, basically, on your behalf. You know, I myself, you know, I definitely lean more libertarian. I'm not really interested in that premise. I'm much more interested in deciding myself what pension fund, what hedge fund I want to provide my capital towards. I'm not really interested in taking it, you know, in letting them take the taxpaying money and letting that fund the sovereign wealth fund. So I don't like, you know, the idea of it is great because yes, they're gonna, you know, infinite TWAP our bags and that's all awesome and good. But I think
that's why people like it. Let's just be real. That's why people like it.
And this is the issue with so much of crypto sometimes, is that it leads people to lose these ideological beliefs that they have. It's like, okay, well, if we're all like free market believers, and we're also excited about this idea that we create like a tax-funded hedge fund, I'm not on board with that idea.
I think there's like an underlying, I agree with that. It's more government. There's things that make sense for governments to help incubate, and I think they do that already quite a bit with all these other agencies and things. But the underlying thing that maybe people don't talk about is if you have a balanced budget, responsible monetary policy, and people respecting the value of fiat, you sort of don't need Bitcoin. Like, you know, so that's, I mean, I'm a long run believer because I don't think those things are going to be achieved by governments globally in perpetuity, but that is the truth. If Bitcoin was born and exists in, as a flight of safety, a store of value and protection of purchasing power. So if you don't have those, which is what a smart treasury sector is attempting to do, yeah. And then on the other side, I think that doesn't get enough talk is at least the possibility that the US's strong state sponsorship of Bitcoin makes it at least relatively less attractive to countries like Russia, who just got hundreds of millions of their reserves confiscated essentially, and sanctions and all these sorts of things that, like you said, are the ideological foundation of it being an outside the system asset versus something that has state sponsorship and embrace.
Okay, Mike, I want to get into with you about what I felt like is the big theme of this conference so far, which is, you know, it's a lot of an institutional audience, and they are very excited about the crypto industry right now. It feels like, you know, finally the regulatory unshackling is occurring. They can finally start to allocate in ways in confidence. You know, we can have banks start to actually custody digital assets. This is like fantastic stuff. But then, you know, you go on crypto Twitter, you go and check out what retail is feeling like right now, and it's just it's abysmal. It feels like a bear market. There's just been the meme coin market implosion. Like, what is going on? Which side is right now? Is institutional just exit liquidity and that's the smart money, or is it the opposite?
I don't know. I mean, I think the thing that's working right now, right, is, I mean, you know, keep in mind, Bitcoin's been around for 17 years, right? It was the opposite of a smooth run. And now it looks so good. There's a strategic Bitcoin reserve that the US has laid out. Everyone knows what the narrative is, but man, I mean, there were so many times when it looked like it wasn't going to make it. It took a long time to get here. Everything else in crypto is much, much newer than that. I mean, even like the second most battle-tested ground here would be sort of DeFi built on Ethereum. That's been around for 6 years, you know, if you're being pretty generous. It just takes a long time for these things ultimately to get built out. And I think underneath these undeniably positive headlines, there are still big ideological and almost technical and frankly like political challenges to deal with. Like one of the big unanswered questions is how has largely much less regulated and importantly non-KYC DeFi going to interact with traditional finance? Like that is still a very open question that people don't have great answers to. These are thorny questions, but they're not impossible questions, and eventually they will get answered. I would guess that, and the reason why none of the crypto natives really like that is how do you invest in a stable coin, right? Like, is USD going to $5? That just there's nothing to buy. I mean, it's pretty buy or sell, and so it's not going to be sexy, but there is going to be a long build out where you have what you have at the end of the day is a better and very different financial system. Only once that has been solved and rolled out to enough people can you get businesses that wouldn't be able to exist otherwise. And so I kind of think we're in for a couple of years. I think the other thing that's going to be difficult for people to wrangle with as well is, there have been different phases of builders and investors in this space that have done well. If you got here in the early days, I mean, you were an ideologue. Like there was no reason for you to be messing around with Bitcoin in 2010 or 2011 unless you were pretty libertarian and you had an ideological reason for being here. And the next phase was honestly, it was catalyzed mostly by Ethereum. And it's like, hey, we can actually build stuff. And you brought in these tinkerers, these like visionary founders who like looked way into the future and somehow, willed what we have today into existence. But now what we need today is scalers and operators. And so, that's going to be disappointing. That's going to be actively disappointing to ideologues and tinkerers who don't want that to be the case. And there's going to be a lot of churn while the hard stuff actually gets built out. And so I see a lot of optimism because I think a lot of this stuff is going to finally start to work at scale, but it's going to actively upset the group of people that are currently here, is my bet.
Okay, we got about 5 minutes left here, and I just want to go through. I'll start with you, Quinn, but I want to ask, and I'll go last as well. But what is your highest conviction trade or bet for the next 4 months?
Yeah, for me, it's longing duration bonds, TLT, EDV type of 10 to 30 year until the Fed blinks and cuts, which is at least a couple months off. So, or we get further enough correction in risk assets to elicit a change in tone from the administration and Treasury and Fed. So, other than that, the reason buy the dip has worked so well for stocks and risk over the last 2 years is because it never affected the economy and earnings. So, going back to late summer issues last year with the yen, that was more kind of nuanced technical deleveraging. It wasn't an economic issue. The April real yield scare of 24 with kind of Middle East issues, again, sort of an inflation scare, but not an earnings thing. October 23, similar deal. March banking crisis, backstopped immediately, but there was concerns. But this is the first time where it's like, oh, actually, no, there's actually downside earnings potential with everything that's happening from the fiscal side and no liquidity support from the Fed. And that is what I think drove such a steep deleveraging in the equity markets and why I maintain a bit more caution than maybe the average person here. And again, I just really, until the Treasury starts to do, until their words and actions don't line up, then I'll start to maybe question it. But it's very clear to me at this stage that, and we're so early, right? I mean, the correction was swift, but it's like 1 month. Like 2022 is 12 or whatever, 10. So these things can last, and there's just really no reason for them to, if they reignite the economy here, yields go up. And this is very counterproductive. And they have plenty of time. Midterms is the next stop, the stopgap, and you work back a little bit. We know how short people's memories are. And so I kind of think for the remainder of the year, it's like you can imagine the administration is like selling calls on the equity indices and risk assets. Like they don't want it to collapse, but they don't really want it to, be ripping face like Yellen and Biden into the election. So, yeah, I think selling upside when on rallies and being long bonds until they're forced to pivot.
Mike?
I'm not a trader, so you should not listen to me. But I actually, I kind of like Robinhood here as an individual stock. It's, there's an enormous amount of attention that gets paid towards Coinbase as an index bet on crypto. Robinhood's a very similar business. They have more monthly active users. They have an even more retail user base and more valuable order flow. They have a really competent team in crypto. You can see Vlad Tenev posting on Twitter every other day about all the stuff that they want to do. They want to tokenize a bunch of assets. There's a huge amount there, from launching an L2 to doing a stable coin, basically just running the playbook that Coinbase has run. So something to watch. Not investment advice, not trader.
You're a believer in the tech, that's for sure. Long-term time horizon. Okay, my trade for this is something that I've been shopping around and still thinking about, but I'm bearish Mag 7, generally speaking. I think there's too much capital in it versus what's happening in the rest of the world. So the thing is that, the rest of the world, Europe equities, they've just been going gangbusters and parabolic. So I don't really want to touch that either. And I've been thinking more and more about short QQQ, short NASDAQ, long Bitcoin. And here's why. Bitcoin is a global asset that is affected by liquidity. Yes, mostly U.S. liquidity, but the fact is that when you have what's happening in Europe on the fiscal, when you have what's happening in China on unleashing, they've been doing the monetary thing, but now they're really coming in size on the fiscal thing. I have a feeling that as there's outflows out of NASDAQ, out of Mag 7 going back home, that Bitcoin, well, this is always the debate, right? Is Bitcoin just highly correlated to NASDAQ? And I might see this opportunity for a decoupling there, where just the liquidity impulse from the rest of the world starts to uplift it. So, obviously you want to match the volatility or the delta there, but I think short NASDAQ, long Bitcoin is interesting for that reason.
Particularly as long as gold keeps its ascent, I think it's a reasonable. If Bitcoin succeeds, it has to decouple from long-tail tech at some point.
Yeah, there you go. All right, that's all the time we had. Thank you all so much for coming. Quick plug, we are doing a forward guidance meetup in a couple hours, so come by for a beer. We'll be there. It'll be fun. Yeah, thanks for listening, everybody.
Cheers, everyone.
Thanks.